Hello everyone, welcome back. So today I'm planning on covering a few things. I wanted to end the Bond series, so I feel like that was a potentially a good thing. I wanted to finish the Bond series, and then I have some potentially good video ideas for my future. So I think another good challenge would be to do, if I will pop up Notepad, I'm planning on probably doing a few challenges. Like I was thinking about doing a high risk strategy, a high risk series. Basically showing everyone that if you guys take a lot of risk, it can potentially be consequential to your return. Because like the name of the game of investing is trying to invest money and reduce your risk while also maximizing your return. But a lot of the time, the more risk you take, the more chance that you have of losing money. So a high risk series, I think, will be very interesting to see. And I bet you I'll probably lose a lot of money, but I'm probably going to do it very, very smartly, and hopefully I'm going to be worth like a lot more than 2 million, because right now I'm currently in my bond series, which I imagine a bond portfolio. I grew 100k to 2 million, and so I think that'll be interesting. I also have a few other floating ideas about what else I should do for stuff. Like I have a bunch of other series ideas. So I found that pretty interesting. So I feel like that's about it. I'm going to probably pop up with a few other ideas that I think they'll be good. I've done a balance series. I've done a everything series. Well, like the main series I've did before this was a everything series. I just invested in everything. But I like setting limitations. That way I can learn from my mistakes. So like that's how you get good. In the name of the game is to get good at things. Bond portfolio series. Here we go. So, if I go over to Open Save 5, so this is where we go into our gameplay. So I said in my thumbnail that I have $2 million started. I'm gonna go ahead and get some music in here. It's probably good enough. So today, I'm probably going to get into retirement. So we retire, I think, in 2050 something. Yeah, 2052. So we have a few years to go until we basically get worth it a lot. So where we left off last episode, I decided to invest a lot of money into bond funds, which are technically bonds. Like they're stock, but they're managed by professionals, like ETFs. So it's very, very passive in nature. That's also another idea I was thinking about doing. Video idea series 2. Oh, I swear I changed my bitrate. Whatever. Hopefully it's alright. So last episode where we left off, I bought a bunch of bond funds. That's another idea I'm thinking about coming out in my head, is an entire series where I don't buy individual stocks, or at least I buy barely any individual stocks. I just buy bond funds, and I buy ETFs. Because I think it'll be a lot interesting. And like where we left off last episode too, I was talking about fund investments and stuff, and why personally I'm probably in real life too also going to do more ETFs, because I can outsource a lot of my work and I can reduce my risk. Because if I buy for example, an aggressive growth shares ETF, they're going to use triple leverage, so they're going to borrow money in order to invest. And when I invest in this ETF, I can probably only lose 100%. Whereas with if I were to go out there and take out triple leverage for myself, I could lose a lot more than 100% because I have to pay back that loan. But it's a lot easier with this thing. So I feel like I'm definitely going to be using this when it comes to my high risk series that I'm planning on doing maybe next time. And I was also thinking about doing an ETF, and maybe also trying out some other strategies and trying to get a little bit more perfected at those. And I may bring back the bond series. So I also said my thumbnail or like my description about how important risk management is. So I found this interesting article on Zacks. So Zacks is actually pretty helpful, but a lot of the times you have to pay for their research. But this is a pretty nice free thing. How much returns you need in order to recover from losses. So in my opinion, The reason why my personal portfolio is very, very low risk is because I think risk reduction is the name of the game. I try to reduce my risk a lot, and whenever I do take on high risk activities, I usually say I'm probably okay if it be going down 100%. So, for example, I just did my timestamps for my my personal portfolio series, and I ended up talking about like the two stocks I bought, which was Hot, and also I talked about American Hotel REIT. So that's a very, very high risk speculative stock because I really don't know how long coronavirus is going to last. And then another one I ended up buying was a mine stock, which I found is a high risk stock. So speculative is basically I don't know if I'm going to make money on it or not, and high risk was basically, hey, I just accepting that there's high risk with this investment, a lot of volatility, etc. So I found this very interesting because I had to do a bit of digging in order to find this article, but apparently, where is it? Big losses hard to recoup. So the math on it is if a loss of 10%, so I can get my highlighter out. I have this little tool that highlights things. A loss of 10% needs 11% gain to recover. So like that's the name of the game. Name of the game is if you lose money, it actually doesn't take, like for example, if I lose 10% of my bond portfolio in real life, I have to make 11% in order to break even. It's not 10%, it's that. And it actually gets worse the more severity of your losses. So, for example, I lost like at highest 50% on Suncor stock. So I bought Suncor stock, and then this whole oil thing happened. I lost 50%. So in that case, if I do like a bunch of this math thing, I need 100% gain to recover from that loss. And a 80% loss is 500% gains. Oh, yeah, 8% gain, you need 500% in gains to recoup back where you started. So you think about that. I like to think of it as also like really, really complex, because if I look at my actual portfolio, I'm basically in trouble with some of my positions because I bought highly speculative companies when I first started. So this is going into real life. What I did is I bought a bunch of highly speculative companies. So during the weed bubble, like we had a weed bubble in Canada where people were bringing up valuations of weed stocks, I bought into Supreme Cannabis, and I bought it at $1.80. It's currently at 31 cents. So I lost about 82%. So if this article, and it is most likely correct because this is a very, very reputable source, I'll need about a 500% gain on Supreme Cannabis or Supreme Weed in order really to break even on that investment. And with Cineplex, it's a 50% loss. I would need a 100% gain in order to recover. So if you think about it, this is why one big reason why I'm more of a low risk investor, because I'd be happy with 4 or 5% returns than losing potentially half my portfolio, because that's just my personal risk tolerance. Like I like my portfolio too. I've done okay on some things, but I've done okay on some investments in here, and I'm pretty happy. But I've made some mistakes. But I'm trying to just manage risk in this portfolio, and in portfolio 3, I'm trying to go for growth and try to mitigate risk with this by picking up great companies and such. But portfolio 1, I exposed myself way too much to speculative companies in this portfolio, and it's kind of hurt me a lot. So I think that's one big reason why I think people that are in Wall Street bets should really watch out, because if you buy stocks at extremely high valuations and they're highly speculative in nature, your chance of losing money is a high amount. And the big problem with it is if you lose money, it actually takes a lot more of a percent return in order to recoup those losses. So that's why I'm a bit more of a low risk investor, because if you lose money, it's a lot harder to recoup your losses. And I'll make sure to I'm actually going to edit this stream. I'm going to copy and paste this, and I'm going to do this in the description. There we go. That should be alright. Hopefully that updates for you guys. So That's enough for the little rant, but I found that pretty interesting. Then again, I also posted something in the bottom right, bottom left, saying that this is not really taken as financial advice. Please do your own research, etc., etc. But now we're gonna go get started with the series. So now we left off where we left off. We have a bunch of money in bonds. We have a bunch of money in stock. So I'm planning on probably doing more convertible bonds this episode, because I'm going to be trying to grow my wealth at a very fast rate, or at least a faster rate than we currently are. We could potentially lose a lot though, because convertible bonds, we're going to be actually doing stock. So for example, Natel, a National Bank of Greece or whatever, we got into this stock, and we actually got in through it for a corporate bond, which I found very interesting. And so in that case, we actually got in that for a corporate bond, and so technically I could actually sell this for a profit, which will be nice. And I'm not too sure if you guys are going to count that as me breaking the rules, but I'm just going to keep it for dividends. I could sell it right now though if I wanted to and take some decent profit. But as of right now, I'm going to go ahead and get the streaming quotes because I want to see where the current interest rates are, etc. It's a nice little terminal. So now we're going to go ahead and get started with the actual series. So as of right now, like I said last episode, I could have done bond laddering, but it makes sense to do it when it's actually worth it, because I don't want to spend a lot of time looking for bonds and such. We could probably do some convertible. I might just do like $100,000 in a convertible bond. That's due soon. So I want to see the current year. Currently 2039. Yep, we're good. So I'm looking for a very, very liquid convertible bond. If we make some decent profit on it, I'm happy. The one thing I don't like about convertible bonds in this series though is that they tend to pay less coupons than the actual bond, because the conversion option is actually expensive for the company because it dilutes their equity, etc., etc. For example, that's one of my concerns about buying my Cineplex bond IRL, is because when I actually bought that Cineplex bond, the X amount of shares they have, they could potentially it could potentially dilute their equity. Basically, add more shares, and current shareholders would be pissed, because it's kind of like if you have a pop, if you have like a pop or some kind of like water, and I like to think of it as Pepsi. Like you have Pepsi or your Coca-Cola or your soft drinks, and you just add a little bit of water to it. It probably tastes like trash, but you're adding more liquid content to it. So like, that's what I like to think of it as. Like if I have this, not really sponsored in any way, but like if I have this Coca-Cola right here, or I have something, if you just add more water to it, it's probably gonna make it taste like very bad. So that's a bit of a thing, because like you're adding more shares. Oh, government's raised income tax to 33%. Huh. I like these jokes they say. But in this case, taxes have been raised, so potentially this may change my investment ideas. Because right now, corporate tax rates are 33%, ordinary income is 38%, and capital gains is 32%. Still, capital gains is the most efficient in this game, but it's gonna really, really hurt us because tax rates have been increased. That's really sucks. Crude right now is a really good deal, I think, but I don't want to take on a futures contract because that would be breaking my constraint. So we're gonna wait one more year, and then I might end up buying something. Let me know if the quality has been increased, because I think I was at 2,500 bitrate, and I think I ended up increasing it to 3,200 bitrate. That's just because YouTube suggested. Why is there no data? Oh yeah, it shows. It's just a little bit slow, I think. But hopefully the stream is working fine. So like I actually ended up, so I ended up changing the bit rate to like 3,200 or something, because like the recommended I think is 2,500 or 2,000 to 4,000. So I thought 3,200 was a decent bit rate. I may have to do a bit more research on that and see what's suggested. but YouTube suggested that I should change my bitrate to a higher level, and I did that through OBS. So hopefully my quality of my video is alright. I'm gonna probably rewatch this video and see how well the quality is. Hopefully it's alright. So our interest rates are very low as of right now. So our bond fund is doing really well. Our fixed income bond fund. So we're doing pretty well. I wish I could have bought more bonds, but then again, that's not really the end of the world. I'm gonna wait for rates to go up. I think I'm gonna do some bond layering though. So I've seen not really much great deals in the yeah, there's not much short-term convertible bonds as of right now. Okay, so we're looking for like 2040 bonds or 2041. So this one might be a good one to get into, just for a little bit of extra cash flow. 2040 right here, 4%. So I think this one is my best bet, because it would mature very soon. So I'm gonna put like 250k into this bond. Now I gotta pop up my trusty little calculator. 250 divided by, so they're asking 101 for it, so 1010 I think, and so that should be, I'm gonna buy 250 of these bonds, round it up a few dollars. So now we have about $253,000 just in cash, and I'm gonna go ahead and write that down on our like little thing. And this is for 2040, and we're currently in the year of 2039, so we should get a little bit of coupons from that, which will be nice. We'll make a probably slight profit on that, because we'll get a little bit of income from it. Oh gosh, yeah, this is really gonna hurt us a lot, these higher tax rates, because most of our portfolio is around ordinary income. Like we're making a ton in dividends, we're making a ton in interest, while as a bit of our portfolio is capital gains. So I may end up not making 10 million if taxes stay this high, or I might just have to move more of my portfolio towards capital gains income instead of passive income. Because so if you look at my annual cash flow, we have to pay $29,000 in taxes. That's crazy. 250k in maturing bonds though, which is nice. Yeah, I may have to move more of my portfolio into like I don't know, just into more of capital gains kind of income instead of just ordinary income, because ordinary income is just messing us up. This one doesn't look bad either. Might just do a little bit of this too. It's 104. I want to buy about 50k of this just for a bit of a higher risk income. It's a bit of a junk bond, but it's not all that bad. How much are they asking? 104. So we can buy about 48 of these. Alright. Yeah, so we have a little bit of liquidity just for buying government lawn bonds or buying more convertible. I'm gonna start revamping my portfolio. I may end up taking some profits out. Like I'm actually gonna sell this stock. Probably not a great idea for as is right now. I could have done some options on it, but I'm also trying to stick to my constraints. So we're gonna go ahead and take up some capital gains on these companies, like the bond funds. Just keep my losses and such. How much capital gains did we take? about $53,000 in capital gains. That's a pretty big loss, but we could do a tax loss selling hypothetically in this example. We could sell at $50,000 of this company for an intentional loss to reduce my taxes. So in this case, we have about a $53,000 loss. So I might just sell out $70,000 worth. Now we should be able to completely offset our capital gains by taking out some capital losses, hypothetically. I know I just bought the dip on it a lot yesterday. Oh, no. $70,000 divided by the current price. Oh, no, I wanted to do... $39.99. Just want to sell that much shares of this bond fund. It hurts to take a bit of losses, but I might as well just rebalance my portfolio into a bit of I just rebalance my portfolio into more bonds, because just having more dividend income, it's really going to hurt us for the time being. So we should hypothetically have less tax payable. I'm not too sure if we did reduce our... I'm not too sure if that did anything. Weird. Okay, so we have about $350K in cash. So now we're going to go ahead and start eating up some long bonds. And we forgot to add Polaris, or I don't know how to pronounce that. So this is for 2041. So we should be receiving our land Chile bond, 250K. And we're going to be able to lock that into a long government bond and maybe some corporate bonds. So I think that'll be a very interesting things. This is good. Like I said, like last episode, whenever they do this, that means basically they're going to be increasing the rates because there's less supply of credit. So they're tightening to consumers. So in this game, interest rates should be going up. And they have been a little bit, but they're probably going to continue to rise, which is good for us. So I'm glad I bought these short-term corporate bonds. So I'm hyped for 2040 to come, and we're going to be able to get 250K from our land Chile bond, and we're also receiving dividends from our good old ETFs. So we have some ETFs that we bought bonds in. So I'm just doing fixed income only in this example. So I'm not doing any stocks, but technically these are stocks, but they're exposed to bonds, so therefore I let that happen. We're receiving bank. I think that's from our junk bonds portfolio. Yeah. Yep. Our junk bonds is making us quite a lot of money. So it's current year 2040. So we should be able to receive our money soon from land Chile. LFI bonds paid maturity. So we have 625K just sitting in cash right now. So that's pretty beneficial. And I'm starting to revamp my portfolio around a lot, because if we look at the current tax rates, they're not very efficient for us. I'm guessing it's because they have a lot of government debt, but corporation, I ignore that because we're not a corporation. But ordinary income, I think that includes dividends and interest. It's at 42%. I'm paying a lot of money in interest and dividend taxes, so I want to move more of my portfolio towards capital gains, which is a little bit more efficient. So that's why I'm going to be buying up some long bonds and some corporate, some convertible bonds. And then if I make some capital gains on that, basically, if I buy a stock for $1 and it's worth $2, I make $1 profit. That is taxed a lot more efficiently than me making $1 in dividends. Okay, so now I think long bonds are starting to look a little bit more attractive. The short rate just continues to rise. Okay, so right now I think around the 8% rate is usually when I think government long bonds start becoming a little bit competitive, but we could also theoretically We can buy government long bonds for a bit of security of our capital, but I mainly want to do recall database. We can do very, very, very long-term corporate bonds. So like this one, McDonald's Inc., it looks like a pretty good one because it's into 2055. So if I look at that, that's 15 years of me making about 9% yield. So I could hypothetically go even longer than that. But the only problem is, the longer I go, the more risky it is for if interest rates continue to rise. 2060, 9.5. So I'm going to buy long duration bonds. Just if interest rates do go down, I'll make a bigger capital gain. So the longer the duration, the better. 2063, China Mobile. Yeah, I think China Mobile is pretty good because it's got like a 2063. So that's like a lot amount of time that I can get. So I'm going to start buying a diverse amount of corporate bonds. I'm going to go and buy maybe 100k of this McDonald's bond. Yeah, so hopefully my stream is good quality. I've changed my bitrate around to 3200 from 2500. So I want to go ahead and do the buy. I want to buy some MCD bonds. And this is where I like to look at the ask. So we have $100,000 I want to spend. Let's just up that to 250. And we're going to do that for 5, 9, 6. So $56. That's about $596. So we're going to buy about 419 of these bonds. I'm going to do 420 of them. So that will cost us around $250,000. And so now, if we look at my account, I have about $299,000 in corporate bonds. We have our Polaris bond, which I bought around 50k of it. It's considered a junk bond because it's double B, but I think it's coming to maturity by 2041, so it should be coming to maturity soon. But I decided to buy a McDonald's long bond, and its yield is about 9% a year because I bought it at a steep discount. So the discount on it usually at par, aka at $100, it usually pays 4.5%. But because the bond got beat up so much, it's about half that. So I'm making about double that on the yield because the price. So the reason why I'm buying it such a steep discount is because I'm hoping that when it does go to 100, it's probably going to go to 100 a lot faster than the $85 bond I was looking at from 2063, China Mobile. So if I look at China Mobile bond, I don't know if I can find it right where. Just the China Mobile bond, it was a longer duration. So if you see this, it's 2063, but it's at $85. So I'm thinking hypothetically, I think if the McDonald's bond has a bit more, it could run up a lot faster. So I think that'll be interesting to get into. Currently interest rates are at 8. And if interest rates continue to climb, I'm going to go and buy more. So they're climbing. Cool. So my stock portfolio, I'm making major losses on my blue chip bond ETF. But hey, we have a lot of our money in corporate credit right now. Okay, and so now I think it's about time we go ahead and buy up maybe a longer duration, like a very, very long duration bond. Toshiba 2057 for 2060 plus. I'm looking for some highly beat up bonds right now. So this one's pretty good, 2052. 2060. So Merrill Lynch, I think this one will be a good one to buy. And if interest rates continue to climb, I'm just going to use my coupons towards reinvesting more into it. So I'm going to do another 250k to Merrill Lynch. So it's trading at $53. So we have I'm going to put about 250k into Merrill Lynch. 5, 3, 1. So we're going to buy about 471 bonds. I'm going to round up by 1. So that's about $251,000 transaction. It's for a long duration. So if we look at my bond portfolio now, And Polaris, which is maturing in 2041. So Land Chili, they pay us back. Polaris, which is 2041. We have McDonald's, which is paying us back in 2055. And then we have a Merrill Lynch, which is paying us back in 2060. So these are very, very long duration bonds. I'm also going to probably buy some government bonds just for fun if interest rates continue to climb. I really want them to climb though. It's going to hurt the value of our bonds in the short term, but I can use all my coupons and stuff towards specifically buying more. Yeah, so we're having a bond maturing soon for $48,000. I'm going to reinvest that into maybe a government bond, hopefully. I'm just hoping that rates climb. I really, really wish that there was a bit more volatility in like the interest rates. Like I wish they went to like 10, then they went to 5, 10, 5, etc., etc. Because then this series we'll be able to make a lot more. But they've been very, very low for a while. So maybe hopefully I can learn from some of these mistakes I made in this series, and then hopefully we can hit a lot higher of a valuation of oof. Okay, 10%. So now we're gonna start buying some governments. So I'm gonna go up there and I'm gonna go and buy a government bond, a very long one. So this one's gonna pay us a 7% yield because it's trading at a discount right now. So we're gonna go ahead and buy 669. I'm gonna buy about 150 of these bonds. That's gonna cost us about a bit above $100,000. We have 53K in cash right now, so if rates continue to rise, we're gonna get hurt in the short term. But I can reuse my coupons towards locking into longer term. So I think we should do alright as long as interest rates continue to climb. If they fall right now down in the short term, hey, I'm okay with that. Okay, so we also have a government bond that we just bought, right? Which matures in 2052. So it's not super duper long term. So it's maturing in 2052. So the duration on that isn't super duper high. I kind of wish the duration on that bond was a lot higher. Maybe make more sense to average down on Merrill Lynch or a McDonald's bond maybe. I also want to buy some more convertible bonds. Hopefully rates stay high for a while. Let's see what analysts think maybe. So we're at high interest rates right now. So like this is ideal for a bond portfolio, but the problem is we just don't have a lot of liquidity to really go into this. Because I've made a bunch of mistakes by buying into these bond funds, and I think that's what really is destroying my bond portfolio, because we locked a bunch of our money into these stocks and we're going to have to probably sell them for a loss. Yeah, we have no capital gains at the moment. That sucks. If we had some capital gains, I could probably sell those stocks for a loss and then offset my capital gains, but nope. Nope. What are they thinking with the current interest rates? They're starting to go down a bit. Okay, how much are we making a year? I actually might do some leverage. So as of right now, we're making about $100,000 in net income. So I'm thinking oh yeah, so I'm probably gonna take out maybe $100,000 worth of leverage on the long bond. How much money do we have as of right now? I'm gonna take out some leverage on this bond because if it goes bad, so I'm gonna probably take out. I'm probably gonna buy like 175,000. We're gonna take out like 100K worth of leverage, which is 1 year's worth of income. No, 1.7 million. I'm gonna buy the lawn bond, which is 2052. 175,000 divided by $700. About 250 of these bonds. We're gonna use some leverage. About 1 year's worth of about 1 year's worth of stuff. So hopefully rates go down. Hopefully rates go down. Because we did take out some leverage. But if they do go up, it's not gonna be the end of the world because I used a little bit of leverage. I didn't use a lot. If I used a lot of leverage, it would have been great for us. But yeah, it's kind of staying flat mostly. Okay, it looks like they're actually starting to go down a lot. So I'm gonna go ahead and lock into the lawn bond. We're actually going to start using leverage. I don't really care as more. I'm going to borrow 1.8 million. Okay, I'm hoping that rates fall. I'm really hoping that rates fall, but they're actually going up. 100K loss. Okay. If rates continue to rise, we're going to be in a lot of trouble. So I'm really hoping my technicals are correct. Where we can see like that, like there's a bit of a fall, but then there's a bit of a rise, which kind of scares me a little bit. I'm hoping that they're going to go into an easing environment soon, because then we're going to make bank off the lawn bond we bought. But if rates rise, I'm going to lose basically everything. They're staying mostly flat, I think. No, rates are rising. Yeah, they're mostly flat right now, which is great. If I didn't take out any leverage. I really want them to fall now. So as of right now, we have $1.7 million in leverage. So we're starting to pay off our leverage, which is good. What's our borrowing cost? It is 11.5%, and that lawn bond is paid us about 9 points, so we're losing about 2%. But these corporates should help offset a bit of the loss on our lawn bond. Plus, our dividends from the bond portfolio, individual bonds we bought, not the individual, the bond fund. So I'm just hoping that rates continue to fall. Polo bonds pay us back in full. That's great. I think rates are starting to go in a downward trend, but there looks like a bit of a symmetrical triangle, which has me worried. Yeah. Okay, let's go ahead and what are they thinking? Yeah, it looks like there's a bit more of a downward trend going. So we're going to continue to buy more. We're going to take out a little bit more leverage and buy more of the long bond. So hopefully this does well for us. If rates continue to rise, we're going to get hurt. Oh, they crashed. Yes, let's go. There we go, boys. We just made quite a lot of money off that. If they continue to fall, we're going to make bank. Fallen, fallen, fallen. We just took a lot of risk with that transaction, which I would not do IRL because, like I said, the name of the game is try to reduce your risk, but this game is just a game. I'm taking a lot of risk with things. So our transaction, it's starting to go down a lot. The short bond's tanking. So with our high risk strategy, we made quite a bit. We made $600,000 in return. And look, our McDonald's bond and our Merrill Lynch bond, it's almost trading at par. So we've actually made some good profits on that. And our stocks, they're starting to recover. Some good news. I should have maybe bought more of the bond fund. So now we made a bit of bank because we took a lot of leverage out and we took it out on the long bond. So if rates continue to fall, I'm going to go ahead and exit out this government long bond, and we're just going to go ahead and maybe do some convertibles, or I don't really know what to do. But if we do another right transaction like that about 2 more times, I think we could be worth 10 million plus. Hopefully 10 million at least. The economy's booming. So the economy is starting to like pick up a bit, which has me a bit worried that there might be. Oh, they're going more aggressive in London. Okay. So now interest rates should continue to fall, which is good for our long bonds that we bought. I'm still watching the short rate like a hawk. Low oil prices. High oil prices are almost over. We're making dividends for days. Did they lower the tax rate? Not really. I think they might have lowered the capital gains tax. I'm not too sure. But then again, I'm not too sure. If they continue to lower the interest rates, I'm going to be so happy because we're going to take home about a lot of money in that long bond. But we did take a lot of risk doing that. We have about $2 million in loans, but we have about 1.1 million in gains. That's worth 3.5 million. We're going to take home some decent profits from that long bond idea. But we took a lot of risk to get there. Okay, I think interest rates are starting to pick back up. They may continue to fall, or they may... Oh, shoot. Okay, hopefully we still made a profit. Yes, we did. Okay, we're gonna get out of this ASAP because the short bond just took a giant dive. Look at that. That is a terrifying experience for me. So I'm gonna take my profits right now, because if we don't, our long bond is gonna be worth... Our long bond is gonna get completely crushed. Dump them all. So now we have about $1.3 million in cash. So we, thank goodness I reacted quick to that, because if I didn't pay attention to that, it's highly likely that the long bond's gonna go up. I don't know why that happened out of the blue. Like, you saw a bit of an upward trend, but then I was like, it may continue to fall or may rise to around maybe 6% at the highest. No, it's almost at 7.75 right now. So that was a quick little rise in the short bond. So I'm thinking that the central bank maybe changed their mind and they're going to tighten in. No, central bank's saying they don't know, but just like over the short term that thing went up a lot, so it kind of scared me. So now I think we're in a bit of an inverted yield curve, so this should potentially be a good environment for a bond ladder strategy. Because if we look at it, so I'm gonna go ahead and sell these long bonds because I'm pretty sure we're in an inverted yield curve right now, which is very rare. Like I said, like last episode, inverted yield curve is basically when short bonds pay more than long. So it should be a beneficial idea. Let's look at a very long term, 4.5%. And what's the current year? But like, I definitely know for the government, it's inverted right now. Yeah, I think the longer term bonds are paying less, maybe. But I'm pretty sure the long bond may continue to rise because the short bond is up. So I'm gonna go ahead and take my profit out of these bonds we bought. Make some capital gains. So we're gonna go ahead and sell a Merrill Lynch bond. And we're gonna go ahead and sell out of our good old McDonald's bond. And I'm pretty certain that interest rates might rise over the short term or even the long term. Definitely government bonds are good right now. So we got over our bond positions. So I'm pretty sure if it started flattening out, so I might actually buy a little bit of the short bond just as a bit of a hedge. Because if we're in an inverted yield curve, and if the government's saying we need to fix this inverted yield curve because short bonds are paying more than long, that might be a good idea to maybe, like, if they decide to cut the short rate. The government might be trying to cut the short rate. Or it may be a long-term thing for them. So I'm just going to put 250k into this short bond at 7%. What's the current price of the short bond? It's 100. So we're going to buy 250 of them. It's going to pay us about 7.75%. And it's just took a big dive up. So I'm thinking either the short bond takes a tank or it goes up over the long term. So I could have took out some leverage, but I did not. So now we have no more bonds, but we have we have a short, and which is until 2042, which is pretty soon. So we'll make like about a year's worth of coupons. So it's a bit of a liquidity preference, I guess. Okay, and so we have we don't have much capital losses to really offset our capital gains. A little bit sad, but it's not the end of the world. We have $1.4 million in capital gains. So with that giant amount of capital gains we made, if we are still negative on our bond portfolio by like a large amount, I would have just took out a large amount as a capital loss, and we could have offset our capital gains. But I don't see any potential in doing that anymore. But we could, hypothetically, we could get out of our stock positions and just do individual. We could just do individual bonds only. But we only have $5,000 worth of losses, so there's no sense. Oh, that was such a good idea. If only I bought more. If I leveraged that short bond position, I would have probably made bank. But the benefit of playing both sides led us to this. Oh, what? Oh, it matured. My bad. But if it didn't mature in 2042, I think if it matured in 2045 or something, we could have made a lot of money off that short bond. So now it's back to normal. Long bonds are paying more than short bonds. So we don't have that bond anymore, sadly. Kind of wish it was for a longer duration. We could have actually probably made a good capital gain on it. So we've actually lost a bit of money on this position. Doesn't repay us much either. Do we still have our capital gain? No, we don't. Oh, I could have offset that loss. Not the end of the world. So right now, this entire 1.8 million is just play money. I can do whatever I want with it now. So my main objective right now is going to be try to just do some bond iron. So it's time to update everything with my portfolio. So we have about, this is how much cash we have. So right now we have 1.829473 million in cash and about 22 in stocks. I try to update this every once in a while. Okay, so what I'm gonna go ahead and do is what I'm thinking about doing is I'm thinking about maybe doing more bond iron. So it's 2042. So if we do some bond iron, I think that could potentially help us out because we have $1.8 million just to play with. So it's 2042. We're looking for 2043, 2044 bonds. Just some nice mature some nice liquid bonds, because if rates do rise, we're gonna be all right. But I want to make some interest while I'm waiting for interest rates to rise. AW root beer. This looks like a really good bond to get into. So I'm gonna put about quite a bit of my budget into it. So we have about $1.8 million in cash. I'm gonna probably put 300k into this bond just because I want to make a little bit of interest while we wait for it to mature. So it's into 2044. So we're gonna have to wait a fair amount of time for this bond to mature. But we're making 6% a year for 2 years, and we have to pay $101 for it. So I think it's a really good deal. So I'm gonna buy about 300 of this. I want to round up by dollars now. I'm gonna buy about $305,000 of that A&W root beer bond. Oh, did not mean to do that. So now we have about $304,000 in A&W root beer bonds, and the maturity date is 2044. So this is for 2044. We're looking for a 2043 bond too. I think that'll be nice. A Honda motor, 6%. So if we can hold this for about 1 more year, that'd be great. So I want to put about $1 million into this bond because I think it's gonna come due very, very soon. So I'm a big fan of this Honda bond. And it's gonna mature in 2043. So that's about 1 year from now. Oh, I should have looked at the price. So in this case, it's gonna cost us, I'm gonna do $1 million worth. It costs us about 101 per bond, so I'm gonna buy about 9,900 of this bond. What? Oh, I did $101. That's my bad. I meant to do 1,000. There you go. That should be good. I'm gonna buy 999 because I'm like, what? Could have probably took out some leverage, but I didn't want to. So right now we have a Honda bond for 2043 and a root beer bond for 2044. Both paying us about 6% yields. So the NW root beer bond is going to pay us a bit more, but it's for a longer term. And I'm going to go and maybe try to find a 2045. We're just going to do every year. We're going to have a ladder in position. 2045. Is there any 47 payless drugs? That's not bad. 2045. Now it actually probably makes sense for me to do this. Atlas. So this is probably a good one because it's a bit low, a bit below par. So it's for 2044 though. That's the one problem. So I'm gonna probably buy 200k of this. So we're gonna be a little bit betting that interest rates kind of stay flat for about 1 year, and then if they start raising, I'm happy. If I buy, so this is $962 a bond. So I'm gonna buy about 208. That's gonna cost us about $200,000. So now we have about $1.5 million in a bunch of short bonds. So I could have done, maybe when we're managing a lot more money, I could probably do every 1 year. I could do like maybe 100,000 or 1 million plus. But we don't have a lot of money at the moment because we're not making a lot of return off our bond position. Because bonds don't make me much, but I think this is interesting to get into. There we go, we got our bonds in. So now we're just gonna wait. Interest rates are rising. So thank goodness we kept a little bit of liquidity. Like we have $324,000 in cash minus our tax of $8,000. So we have quite a bit of liquidity. I'm just keeping this liquidity just in case if rates shoot up all of a sudden out of the blue. But as of right now, I want to do the bond ladder for 2043, 2044, because if rates decide to stay high for a long period of time till 2044, hey, it's good. But rates could have stayed flat for a while, so that's why I decided to buy a bit of a short-term bond, because what if rates stay low for a while? Then it makes more sense for me to hypothetically just lock into my short-term bonds. Yeah, right now rates are falling. I kinda wish we had more money to play with. Like, we don't have a lot of money to play with. We only have a few million, so I can't buy too much. Like, I was playing Wall Street Rare, and if I want to do that, I could probably buy billions of dollars worth of bonds and have fun with that. Just receive bank from corporate. But as of right now, we only have a few million, which isn't bad. I don't want to be too greedy in this game. Here, our high income bond has actually made us money for once. So I'm guessing that's good because interest rates are currently flat, mostly. So junk bonds are just amazing right now. I'm guessing that's just because they can refinance at lower levels. So it's really, really good for them. It's currently 2042. So we have about 10 more years left until I like to call it retirement in this game, which is basically when we decide to retire. We had about $4 million in net worth, and then somehow it tanked. I forgot what we did that made it tank. I'm guessing that was our taxes. Yeah, we had about $1 million in taxes payable, and we didn't have any capital losses to offset it. We had a little bit, but we didn't have that much. So I kind of wish I had some capital losses to offset our capital gains. That's if we ever did. You don't want to lose money intentionally. But hey, it would have been a pretty decent play for us to do that. Yep, rates are staying low for now. Okay, let's put an extra 200k into another short-term bond. I'm gonna do 2043 though, because I don't want to risk. What year is it? Yeah, it's almost the end of January, February, March, April, May, June. So we have a few months, so we could hypothetically buy a 2043 bond and make a little bit of money. Right here, we could buy this and make some money. So that wouldn't be a bad idea. Maybe, cause like this bond will be mature in like a few months. So hypothetically, I'm gonna buy 450k worth of this bond. Just because it's gonna be mature in a few months, and we're gonna make a little. Oh, that really sucks. Okay, I guess we'll be buying 2044 bonds then if there are any. But I'm not going to buy as much because, of course, there would be less liquidity in there. Yeah, this one's not too good. It's not bad though. 2044. I need 2024, 2025. 2045 wouldn't be bad. But that's just an extra year that potentially interest rates could be higher or could be lower. 2048, that's a very high risk bond as right now because we're in a lower interest rate environment. Yeah, I'm not finding good things. 2044 right here. Oxford Health Bond, triple B. So I'm gonna go ahead and put a bit of money into this. I'll put 200k. Let's do 250. We'll have about $200,000 just in liquidity for anything. And the current price is about 1,000. So we'll buy about 250 of them. So as of right now, we have a Oxford Health Plan bond, which matures in 2044. Oxford. So we have quite a bit of bonds right now, but this A&W, this Honda bond should be coming due soon, which is good for us. Okay, now we don't have much cash. We have about 200k in cash. I'm gonna round that up. There we go. And we have no taxes. Never heard of that before. Taxable ordinary loss, but okay. I said I would be doing more convertibles too. I'm probably going to be doing a little bit more convertible bonds too. Maybe when our Honda bond comes mature, I might do a little bit of convertible bonds. But as of right now, I'm mainly just doing individual bonds. If we can find a very, very liquid convertible bond, maybe we can do that. Let's go ahead and try to see if we can do that right now. Early 2042. Looking for somewhat liquid bonds. Yeah, this is not Minecraft. I selected it as educational, but my bad. I also say what like the game is. How are you doing today? Yeah, I really don't play Minecraft all that much. I play Minecraft a little bit, but I don't really stream it anymore. Pretty bad, pay 0%. Yeah. Hello. What's up there? Yeah, I think this one would be a good one. Let's buy 200k worth of this. Let me look into the individual companies, see whether or not it's going to be a good idea. Jefferson. 2050 though, it's a bit of a risk because it's a few years out. What's the conversion on it? I'm generally curious. $47. So I already have to bet for it to go up a lot. Are there any like there are deep discounts? JCPenney. Which just showed you the conversion price. That'd be pretty interesting to get into. 2045. Carl's Jr. This might be a good one. Current price is $9. Conversion is 17. Ouch, that's a bit of a return I need. Yeah, let's take a little bit of a risk with this one. It's not really that risky, but current price is 900, so it'll be 995. I'm gonna run that up. About $200,000 transaction. Cool. So now we have barely any liquidity. We have a Carl's Jr. convertible bond. I'm gonna start doing these a little bit more because I'm kind of interested. So if it goes to like above 17 in the next few years, I'm happy. If it doesn't, it doesn't. But I think it does be interesting because we can actually potentially own a stock. I'm more of a fan of the banks though, but whatever. So once the Honda bond comes due, I'm gonna be happy because then we're gonna have a bunch more liquidity to play with. Now we're just gonna wait. Honda bond is paid for. Awesome. So now we have $1 million in cash. We have no capital gains, but we have taxes to taxes of about $8,000. 24k in ordinary taxable income. Interesting. But our Honda bond came due. So now I'm gonna start buying maybe more 2044 bonds and more 2045 bonds because interest rates are still kind of low right now. They're at all-time lows. So let's start doing more convertible. 2046, 2045. That's a potential good one. Qualcomm. $2044. That's double B though. Yeah, let's just do Qualcomm. Where's Qualcomm? There we go, Qualcomm. Current price $40 a share. What's the conversion for the bond? $54. So what's the coupon on it? Because I don't want to lose a bit of money buying this. Qualcomm pays about 1.89%, so it's probably going to be actually a pretty bad bond to buy, maybe. I'm not going to do too much convertibles then. I should maybe save that for a bit earlier on in the series instead of doing it later. I'm more of a fan of just receiving income off of it. Then again, I also want to aim more of my portfolio towards capital gains, so let's just go ahead and do that. So let's do Qualcomm, I guess. Take a little bit of a risk with that. Let's buy 200K with the Qualcomm. So I have to go up about 14 bucks in order to make a capital gain on this stock. Divide by current price is 103, so it'll be $1,003. That's right. We'll buy 200 of them. Around 208,000. Yeah, so we'll keep a bit of money in liquidity. I want to do some regular bonds now. Where are we? So we have some Qualcomm. We have a 2045 Qualcomm. I should separate these two because they're convertible. I want to mess around with the convertible bonds a little bit more. I'm just do CONV for convert. Okay, so now we're gonna do some regular bonds. These are convertibles. So if the stocks go up a lot, then I'm gonna be happy. So I think Qualcomm's conversion was, I think, $54. I definitely know this one was 17 bucks. I'm pretty sure this one was $54. So if Qualcomm and Carl's Jr. go up a lot, I'm going to be able to convert it, and I'll be happy. So in this case, we're going to look for some regular bonds. I'm going to look for the current year, where current year right now is 2043. 2043. 2045. Can we do 4? No, we can't. See, so I wish I could filter this out a little bit more and see how I show the specific year. It's a little bit of a mess as of right now. 2046. 0%. That's pretty bad. Yeah, I'm not finding super good deals right now. I'll buy about 100K worth of this. Let's buy about 100 of them. There we go. That's probably good enough for now. National Beverage, which is 2046. There we go. We're semi-liquid now, but I have quite a lot in cash just because at the moment I can't find any super duper good deals. Let's just do one more and that's it. I'll put about 300K into this one. The North Face. No. That might be a good one though. 2045. Let's go into a bit more of a junk category. I want to make a little bit more interest. That one might be bad. Good. Denmark, Maine. 300K. Nope. Let's buy 300 of these. 303,000. So I'm probably I think I should just do more triple B's. Take a little bit more risk. I'm mainly looking for A bonds at the moment. Oh. There we go. So we're practically good right now. I'm gonna start looking for a little bit more lower credit quality bonds. Not gonna go into the double B's though. I might do a little bit of double B's. The odds of right now, I'm mainly going for double A's and triple A's, where they basically have a very, very high chance of paying me back. Yeah, sure. I'll be doing higher credit quality ones whenever interest rates are low. No, whenever interest rates are very high. Let's do some 2045s. Let's go way down. Coupon one. Well. Yeah, I could play around with this forever. ACO 2047. Let's do 100k in that, just for a little bit extra interest. Actually, let's just do 300k of these. Okay. Oh god, I have no liquidity now. That sucks. So ACO, which is this 2047. So this is 2047. So as of right now, a lot of our bonds are coming due soon, and we have some bonds that are longer duration, like the Denmark Main 300k, 300k. So by 2047, I'll have about 300k coming due. This won't be about 300k coming due in 2044. So we have quite a bit of bonds coming due soon, which is good. National Beverage is going up quite a lot. Qualcomm is actually near the conversion price. So if we look into this, Qualcomm right here. Currently, we've made actually a good price, a decent profit off it, because it's worth more now because the actual individual stock is near conversion. And then we also have where's the other convertible? Carl's Jr. We've actually made some good money off Carl's Jr. because I think the conversion price was 17 bucks. It's currently at 21. So as long as Carl's Jr. and Qualcomm continue to be even more profitable in the long term, these convertible bonds are actually going to be really, really good for me. So now I have a bit of a best of both worlds, like I like to say a lot of the times. Because when you buy convertible bonds, you have the appreciation of the individual stock. So as the individual stock goes up in price, your bond goes up, and you also receive the interest from the convertible bond. So it's really, really good during this super duper low interest rate environment. So that's why I'm a big fan of it. And as of right now, our income, we're making about 100k in bond interest, 3,000 in dividends, less our taxes. So we're making about $105 a year, $105,000 a year. We're having about $1 million in bonds maturing soon. We're gonna have a ton of liquidity. And I'm gonna roll that into some 2045 bonds, maybe some 2046 bonds. And if rates stay low for a while, we're gonna do okay. We're not gonna do super duper great, but we're gonna do okay. And I'm gonna start doing more of these convertible bonds because they're a lot more fun. Because as long as Carl's Jr. took a tank in price, oof. So because Carl's Jr. took a tank in price, we lost our 50k in profit. Qualcomm, it actually went up in price. I think Qualcomm, yes, it did. I think. So that's good. So I'm betting that Qualcomm and Carl's Jr. does well over the long term. So if I look over here, I'm going to look into the individual stock of Carl's Jr. They have not a lot of liquidity. They have a lot of debt. So this is the one problem with Carl's Jr. They have a lot of debt. They have a very high PE. So Carl's Jr. isn't really that great of a company. They're A though, so like they're investment grade. But the problem is just they're gonna be able to pay me back on the convertible, but the individual stock is very highly speculative. So I'm pretty sure that I'm not gonna make any money off Carl's Jr. on the conversion price. We'll just make a little bit of extra income. But Qualcomm, I think that's a really quality company. So let's look into it real quick. Qualcomm. So they have quite a lot in cash. AR is all tied up. They have a lot of debt, like Carl's Jr. 20 times earnings, so that's actually a little bit more reasonable. You're actually paying a little bit more reasonable for the price. $1.24 a share. So it'll be interesting to see if Qualcomm goes to maybe $100. We'll make some good profits on it. So as of now, Qualcomm, we made quite a fair amount of money off of Qualcomm bonds. So if I look into Qualcomm, the actual stock chart, it's just going up and up and up. So that's one thing you want to do is you want to look for a lot of price momentum potential whenever you're doing convertible bonds, because we have the safety of the bond, but they're not paying us much. If you look at the Qualcomm bond, they're paying us about 0%. Well, I think it was a little bit higher than that. I think it was 1.9%. But Carl's Jr. and Qualcomm are paying me almost nothing. So as of right now, it probably makes sense to actually take my profit out of Qualcomm, unless Qualcomm continues to go up a lot in price. So I'm probably gonna actually do is I'm just gonna go ahead and take out my profits from the Qualcomm bond. Just keep it in cash. So when I take out 77,000, some of this will be principal, some of this will be interest, and it'll be 1,420. So we're gonna sell about 54 of these bonds just to trim out the profit of 70,000. Some of it will be principal, some of it will be interest. We're gonna go and sell about 54 of these bonds, and we're gonna receive about $76,000. So now we're not gonna be whining whenever it does fall, because we took out some of our profit out of the bond. So I really don't care if Qualcomm goes up or down. If it goes, preferably we want it to go up, but we trimmed our profit, so it's not really that big of a deal. So we want Carl's Jr. to continue to rise, and we can trim more of it, hopefully. This is what I like, is I can do more of this. So now I can do about $70,000 in more convertible bonds. So we decided to trim that Qualcomm for a giant capital gain, potentially. LM Ederson. Oh, we could actually probably also do this. We could do another filter. We could do earns up. So we can look for some highly growth. Qualcomm is definitely a growth one. We can do Silicon Optics. Oosh, that one's a bit expensive though. These are expensive bonds. Let's do earns up. Looking for a little bit cheaper ones. So this one is potentially a good one. So I'm gonna go ahead and get into this one, Champion Enterprise. And it matures, when does it mature? 2052. Uh-oh. So that's a little bit of a risk. So I'll probably put 70,000 into it, and I'll keep a little bit of liquidity just in case the rates do rise. But right now, I think it's a very good idea to get into convertible bonds just for us. So I'm gonna put about my trim, almost all my trim in that I put into that. $831. I'm gonna buy about 85 of these. I'm not, well, I'm technically not rounding up. I just want a round number. I want to buy about 70,000. So we have a little bit of liquidity. Our bond positions. So it's currently, if we look at the current year, what's the current year? It's currently 2043. So our A&W bond should come due. So our A&W bond of 300,000. Our Oxford bond, where is that? Oxford. That should come due. So we should be receiving a lot of cash flow in the next year, just from these bonds that we bought from our bond ladder. And interest rates have been low for a while, and so that's why I'm doing the bond ladder strat right now. Because also we have a lot of AUM. We have like a few $1 million to manage. So Champion Enterprise, that's our new convertible bond. So Champion, it's for 2052. My bad, I'm doing a 3. And if we look into it, what's the conversion price of Champion? It is $37 a share. So if it goes to $37.01 a share, I'm happy. So if this stock goes up a lot over the short term, I'm happy because we can make some good. We could potentially convert it and make some decent profits. It's going down, so that's going to hurt the value of the bond a little bit. We're doing really well though with our I thank God about these two, because these two are probably actually going to hold the bond funds, the bonds. Whereas with those long bonds, I sold them a long time ago. Oh, rates are finally starting to rise. Nice. Oh my gosh, the this bond fund, the high income bond fund, it's been paying me so much money in dividends lately. Very, very good for us. So we have about $200,000 in cash. Some that we'll have to pay in tax. $71,000 in corporate bond interest. So that's from our bond ladder strategy. And some of our convertibles. Dividend income. And so in this case we have our bond premium. We deduct that, and we got quite a bit of tax to pay. But we also have $1 million in bonds maturing this year. I'm very excited to see this come, because then we're going to be getting about, by the end of the year, we'll have about 1.3 million. And by 1 year from now, rates should be hypothetically higher. And then I should be able to take home a little bit more in cash. But our portfolio value hasn't really been doing much these past few years. There you go, DMR, pay us back full. Cash is rolling in. How much tax do we have to pay? No capital gains tax. Quite a bit of money we have to pay. Champion convertible bonds, we've lost a bit of money on those. Where are they, Champion? Yeah, we've lost a little bit of money in Champion. But Qualcomm, it just continues to go up and up and up. So as long as it continues to rise, I'm happy. So Qualcomm is currently at $85 a share. So I think I'm going to probably exit out of it entirely at 100. Or I might just trim it. I may continue to trim out the bond. Like if it goes to maybe 90 or 85 again, I'll trim out the profit again. Take out some profit, take out some interest. Or it's going to crash, I'm going to lose a lot. So now they're starting to tighten rates for corporations. So if you saw that real quick, I saw that. Interest rates are starting to go up like crazy again. So like this is where, like last episode, we looked into this. I think it took about 3 or 4 years of interest in order for it to make sense to not really take out my capital gains. But a lot of the times the interest rates in this game are very, very volatile. So a lot of the times I like to take out my capital gains because capital gains is also more efficient. So as of right now, we could have probably made a bit of money if we kept our long bonds. But as of right now, I'm pretty glad I cashed out my long bonds a while ago. And we're just doing the bond ladder strategy. And we're getting massive amounts of bonds coming due, which I'm going to use towards specifically just going into more bonds. Yep, so I'm just hoping that rates continue to rise and then we're able to lock in at higher rates. Our dividends are crazy though, like these bond funds we bought, oh my gosh, they've been paying me so much cash flow lately. I kind of wish at the start of the series I bought more of them. It's been kind of flat lately, so I'm going to go ahead, take a little bit of a risk and lock in a bit of my money to this long bond. Just in case if rates do go down, I can make a little bit of some capital gains, but not going to be the end of the world if they do go down. So I'm going to lock in $300,000 at the long. $300,000 at it's $761. So around 762, but I'm going to buy 400 of these, round up by the dollars. $305,000 into some long bonds. So it's paying me about 5% a year. Yeah, so I think we're doing alright. When does that mature? That matures in 2062. So this is like our longest bond that we own. So I'm just going to do that right here. This is 2062. That's a long period of time that we're locking our money in. So I didn't want to do too much of it. So we have about $1 million in cash. Plus we have our other companies. Like we have some 2045 bonds. We have some 2045. We have some 2046 bonds. Some 2047. So if rates stay high for the next 3 years, I'm happy. If they don't, it's not the end of the world. Yeah, so maybe after I'm done this series, I was planning on probably just reading a bit of my books and stuff. So I should update my portfolio a little bit. About 1037991. I was planning on reading a bit of my books though, stuff. Yeah. Might read a little bit more investor stuff too. I think that'll be interesting to get into. Current year 2044. Cool. So all these bonds must be might be paid actually in due, right? We probably have all them 2042. Yeah. So all these 2044 bonds they came due. So I have some 2045. I have a 2045 Carl's Jr. bond, which is coming due soon. We have the Qualcomm bond, which is coming due soon. It's currently, oh gosh, Qualcomm, bro, $144. I'm gonna take my profit. So in this case, it's 50. Where we basically get a conversion price of $54 a share. It's currently at 115. So that's one of the benefits. We actually indirectly benefit from the stock price rise. So I'm pretty glad I bought the convertible bond for Qualcomm. It's made us about $154,000 in capital gains. So I'm a big fan of capital of having some of my portfolio exposed to convertible bonds, because like I said, you get the best of both worlds. You get the appreciation of the stock with the safety of a bond. So I don't know why nobody really buys these. A lot of the times, is lower grade credit quality companies tend to do convertible bonds, i.e. Cineplex. Like Cineplex, they have a lot of debt to equity. Like they have 7 times, so they borrow basically $7 is borrowed for every dollar of equity they own. So it's a little bit of a high risk idea. With convertible bonds more common IRL, like I'm having a little bit of trouble finding them. Maybe if I work for someone, I'll be more interested in convertible bonds because I get ownership in the company and I get the potential to be paid back in full. Whereas if you just go out there and buy individual stocks, you're not owed anything. You're just owed a portion of the company. If the company goes bankrupt, good luck getting your money back. Whereas with bonds, convertible bonds, they're more interesting. So I'm more of the kind of guy who's I'm weird. I'm very interested in preferred shares and convertible bonds just because I find them interesting. And I'm also very interested in common stocks, of course. But I like the convertible. I like preferred shares because there's a bit of a minimum valuation to them. Like if the company decides that their borrowing costs are too high, like a lot of the times with the Fortis preferred shares I buy, they're paying me about 4.02%. And so they think that is too high, and they could just go up there and take out a bond, and it will pay them almost the exact same, or it'd be cheaper to take out bonds. It might make sense for them to actually call the preferred shares at $25 a share. I bought around 14 to 16, so I'm actually getting a bit of capital appreciation. So I find those two very interesting because I'm mainly a dividend investor. I like to receive income I like to receive mainly dividends and interest, but I also like to receive a bit of capital gains every now and then. So I'm pretty hyped. So I'm gonna probably put 300K into maybe another growth. I'm gonna start looking for more growth convertible bonds. I just find these interesting. So we got out of my Qualcomm. Pretty happy got into Qualcomm. That was a really good convertible bond for me. And what's a good convertible bond? I think Roin Software. That would be a pretty good convertible. Let's go and be a little bit. Oh, earns up. Yeah, earns up 10%. Oh. Roin Software is a junk bond type of what is considered junk? Yeah. This one might be good. 2051. So it's a little bit time out, but it's trading at such a low discount. Also, Fort James Group. I think Fort James Group is our winner, but also this one pays pretty high. I'm gonna buy both. Why not buy both? If I like both of them, hey, it's happy. So current price is $14 a share. 2051. It's at $40. Ouch! It's gonna have to go up a lot in order to really be worth it. But hey, it's a bit below the actual par value of the bond. So worst case comes to worst, we're gonna make about almost $30 in capital gains off this bond. So I'm not too bad with that. Okay, and we're gonna pay about 700 for it. So we're gonna buy about 215 of these. Pay a little bit above that. And we're also going to buy that other bond that I think is potentially a good deal. Telly something. Pays a 10% coupon. So these are actually still pretty good. Like the coupons on these are actually high. Let's look into the actual company. It's probably going to be growing. They have enough to almost pay off back their debt right now. They have a lot of debt, which got me a little bit worried. But they've been growing their earnings a fair amount. Are they expected to be profitable? Yeah, they are, for 2 cents. So the stock should hypothetically maybe go up. I'm hoping. So let's do 150K. And I'm going to start doing more government long bonds, more corporate bonds. I mean, this is probably my last convertible bond for a bit. Like, I'm not going to do too much of them because I mainly want income. I should have done more convertible bonds at the start of the series, so I kind of regret not doing that. So I'm going to buy about 250 of these. Cool. They're about 2K over budget. It's alright. So we have Telly something. This is for 2051. I'm just going to say Telly. And this is 2051. Converge. So what's the conversion price for this? We need it to be the conversion price is $49 a share. So as long as it goes above $49, I'm very, very happy, man. Worst case scenario, we make our 100 back. We also get our interest too. So we have a bit of a floor when it comes to valuation of the bond. So I'm still pretty happy about buying that bond. It's not as good as an actual bond, but it's still pretty good. Where's the other bond that we bought? Champion. It's the other $150,000 bond that we bought. Did we get it? Oh, we bought Telly. We bought more than Telly. Oh, that sucks. I meant to buy what was that other bond I was thinking about buying? So we definitely bought Telly. We don't have this bond right here. I want to buy more of this. James something group. So let's buy 150. No, I gotta do a bit of math. Okay. No biggie. So it's $680. We're gonna buy about 221 of these. And now we should have it. Yeah, we have 4 James now. So we bought a little bit more Telly than I wanted. So this is for 2053, right? So it should go on the very bottom because it's longer out. And what's the conversion price for this thing? I should have checked before I bought it. It is $76. So if the stock all of a sudden just starts exploding in price, I'm gonna be very happy. So right now, as of right now, we have Champion. It's at 21 bucks. We need to hit 37 in order for me to become happy. Fort James, I want to hit $76 in the next few years. And Telly, I want to hit 30. I want Telly to hit 49. And Carl's Jr. It's currently at $43. What? Oh, viewers may experience buffering. What? That really sucks, man. Okay. So if we look at this, our Carl's Jr. bond is actually made us. Oh. What? Carl's Jr. Is it 43? Oh, they must have did a split. Oh, okay. I think it's still good quality. There may be a bit of buffer, and I'm sorry about that. So as of right now, interest rates are starting to go in a bit of a downward trend, which has me a little bit worried. We do have a government long bond, so check. We're pretty much good for that if rates continue to fall. But I want them to preferably rise. What's the central bank thinking? They're tightening. That's good. Sucks that we bought a bunch of these long bonds though at high valuations. There you go. The buffering's gone. Thank goodness. So let's just hope that they tighten. Worst case scenario, they don't. We got these convertible bonds, which are more linked to stock. Fort James almost at $37. Telly's at 12. Champion at 18. Cool. Yeah, so I kind of wish I did more convertible bonds. These are kind of interesting. It's going to add a little bit more volatility to our portfolio, but we do have a floor for our valuation. So our Fort James bonds is actually doing really well at the moment. Oh, it's actually not doing all that well. Because I think also because rates are going up too. But as long as these stocks go up, I'm pretty happy. I quote unquote want these stocks to go to the moon. Oh, rates are going up, so that's what's really hurting our bond portfolio, especially our Telly stock, because we have a lot of individual stocks in there. Okay, 8%, so I'm loving that. Bye bye. 645. I should have 646 because I should have rounded up. We're gonna buy 310 of these long bonds. Around a $200,000 transaction. Not bad. So if the rates continue to rise, I'm happy. We did put a lot of our money in these convertible bonds, so that kind of sucks for us. Ouch. But we do have $800,000 in cash. Pretty great. The thing I like about buying these bond funds is that they give you dividends, and every once in a while, see right here, $3,000 in capital gains just distributed to me. So that's the benefits of buying the bond funds. I'm a big fan of those. They're actually giving me, they're giving me capital gain. They're giving me dividends and interest. Okay. What's the short rate doing? It's currently kind of flat right now. Kind of flat too. Fort James is going up. Pretty happy, but we still have a long process until it actually hits the price I want, the conversion price. Tally is at 14, Champion at 12. Yeah, we still have quite a little bit of time. We have a few years for them to play out. It's currently the current year is currently 2045, and these bonds, they come due on 2050. So we have a few years definitely for these stock positions to play out. So how was Carl's Jr. done for us? I think it actually came due. Carl's Jr. Yeah, 2045. So it came due. So do we actually have the Carl's Jr. stock? No, I'm guessing it made more sense to actually just receive my interest. Okay, bonds are starting to take a bit of a dive. Okay, so where are they thinking with the interest rates? They're neutral, so they have no clue on where it's gonna go. Okay, I'm gonna buy maybe 500k in long bonds. It's maybe stupid. How much is that? 345k. Not a bad deal. Let's buy an extra 500 of these. We're gonna expose ourselves to about $700,000 in long bonds. So we have a little bit of liquidity now. We have a lot of government long bonds. We have some stocks. We have some corporate bonds, mainly in convertibles. So that's not bad. So if rates fall, I'm happy. If they rise, it's not the end of the world. What I'm hoping is that rates end up falling. If they rise, hey, I got about $300,000 plus my income that I'm receiving for my bonds and everything. Playing both sides right now. Okay, so our bond portfolio is actually doing pretty well. Our long bonds that we bought, thank goodness we bought them, because interest rates are starting to take a bit of a nosedive. Yeah. So it's starting to hit a bit of the support, so I'm pretty sure that they may continue to fall. What are they thinking? Are they still neutral? Yeah, they are. So it might hit the support right here, and bonds may stay flat for a while, or they may continue to fall. And if they continue to fall, it actually might make sense to actually take out a bit of leverage. But no, they're starting to kind of fly now a little bit at least. Yeah, they're starting to maybe flatten out. The long bond, yeah, it's starting to flatten out, so it wouldn't make any sense to take on leverage right now. Fort James, not doing so well. Champion is being the man. One big thing I'm a big fan of is using these filters. Because using these filters, I have under the database search, I have earns up 10% or more every quarter. So these companies are high growth companies. So potentially, if they continue to grow their profitability over the future, it could potentially be good because the bond should be worth more. Kind of wish I leveraged. It did fly out a little bit though. Nice. These are all highly leveraged companies, so actually during low interest rate environments, they should do a lot better because they have less borrowing cost. Dead cat balance. Wow, never heard of that before. Huh. That's a term I've heard before. Okay, let's start doing a little bit more convertibles. So we're doing convertible bonds still. Let's look for some deep undervalued convertible. This one. Yeah, this one's potentially undervalued. This one's a little bit expensive. Currently at $31 a share. It's a conversion. 131. Uh-oh. I have to go up quite a lot, but there is a floor. There is a floor. Let's buy 150 of these. Around $109,000 to buy that. So it's a 2053 convertible. So if we do a bit of research on that, it's just this weird name. I don't know how to pronounce that. So that's for a 2053, and the conversion was like $132, I believe. Yep. So there we go. And then we have a 2045, so we have a bit of bonds maturing, I think. So our annual cash flow. So I haven't checked this in a while. We have got government bond interest of 72K. If interest rates continue to fall, it's going to make us very, very happy because we bought the lawn. So we're going to be getting a lot more capital appreciation. We have corporate bond interest. We have some annual dividend income, which is very high right now. We got about that. So in that case, bond discount. So we have about 331. The reason why this is positive is because we bought a lot of our bonds at below par. So we have about 122K in cash in taxes, 208,000, and then we also add this 100K in bonds maturing soon. So we're gonna be making so our account value should be worth 500,000 by next year. So we should have quite a bit of liquidity to roll back into some 2046 bonds, 2047 bonds, or just mess around with more convertibles. I think that'll be fun. Especially, convertible bonds are pretty great in this game. It's like $73,000 in capital gains just distributed to me. That's the benefits of having these bond funds. They're just handing me cash day in, day out. Just continuing handling me cash. I don't really have to do any work on it, so I actually may do more bond funds just because we have about $400,000 in cash. I know I said I was probably not going to do bond funds for now, but they're such a great long-term investment strategy, at least for now. So what's the ones that we don't have? I wanted to try to fill in some gaps. We have a blue chip bond fund and we have a corporate bond fund. We don't have any government bonds. Oh, that's not the place I'm looking for. Oh, that's not what I'm looking for. I'm looking for this. So this is what we sold out of a while ago. Long-term and short-term government bonds. 4.41%. What's their portfolio consist of? Not all that great bonds right now, but maybe worth it to get into that long term. So maybe let's just do about 130,000. It's probably gonna be a good long-term investment, especially if they're handing me out a ton of capital gains, a ton of dividends. Potentially, this could be a long-term good idea for us. So I'm gonna buy about 1,800 shares. So we have about $300,000 in cash, and by the end of the year, we should have 543,000. Cool. And we could theoretically take out the capital gain that we made, so we should have about $1 million in cash at the end of the year, minus a bit of tax. Where are taxes at, by the way? That's concerning. Oh, thank God, taxes have finally been lowered. So it's about time. I'm no longer paying like 42% in capital gains tax. I'm no longer paying like 32% in capital gains. I mean, this was like 42% or something on ordinary income. So they finally lowered tax rates. So it's actually good for me to actually go ahead and take some capital gains. And if I have any capital losses, I can offset. So if that new if this new prudent securities thing we bought, if it goes down, or if any of these go down in value, I'm gonna go ahead and just sell them for a loss if I think it's good. So if rates continue to fall, which looks like they're about to pick back up, so I'm gonna go ahead and exit out the long bond. Do we have any super duper long? No, we have some midterm bonds, but like this long bond for the government, I'm gonna probably take my profit and just run. Because rates might rise, they may continue to go down, but I think it's better for me to take my profit. So I took my profit out of the long bond. Now we have about 1.9 million, and we have about $422,000 in taxes, and so we'll owe quite a bit in taxes, but I'm okay with that. So at 422,000 or whatever, it's going to be taxed at 22%, which I'm pretty happy. So we should owe about 92,000. Well, it's when it was 422,000, and I think it was 33% or 32%. So like we actually owe a little bit less tax because they cut the tax rates. It's about time. So that's good for us. So right now I'm really hoping that rates rise and I can start deploying my cash towards more great deals in the bond market. But as of right now, are these convertibles? I don't think so. Yeah, these are convertible bonds. My bad. So I'm gonna probably, I can find some discount convertibles that are due soon. So I might just do an update. So our update on our cash position, it's gonna be a little bit lower than this, but it's just good to keep a bit of a picture of how much money we have. And then we, I'm pretty sure the current year, it's now 2046. Pretty sure we don't have our national bond anymore. It probably matured. Yep. we no longer have our government bond. We sold that. So now we need to do a bit more government. I'm probably gonna start doing is doing a bit more bond layering, just because right now rates are low. They may go up, they may go down. I don't really know. I think it's better I just do some bond layering for a little bit extra interest. And we have some capital appreciation through these convertible bonds. Like bam, 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 bam. These are all convertible bonds. We could potentially make some capital appreciation. That will be very nice. And we could potentially make more capital appreciation through these individual bond funds we bought. And they could be handing us capital gains. They could be handing us dividends. So that's the one reason why I'm kind of long these blue chip corporate bonds, some high income, and this securities government security bond. I'm just interested in receiving tons of interest and tons of dividends from these companies over the long term. Well, technically not the long term, because we have 2046. So we're about 6 years until retirement. So right now I think it's about time I aim for capital preservation for the next 6 years. And hopefully by 2046 I will probably have 5-6 million. Maybe 10 if I'm lucky. But we're not taking super amount of risk yet. So let's look for some regular bonds. Current year is 2046. We're looking for some 2047s, 2048s. And like I said last time, we're going to start looking for some more below. We're looking for some investment grade bonds right here. 24/7, 6%. It's not bad. Yeah, it's probably not bad bond. Is there any other alternatives I can do? This one's probably better. Preview travel. Okay. So this is for 2047. The current year is 2046. So this is a mature in about 1 year. So it's a highly liquid bond. So I'm gonna buy about 1 million of this. It's pretty likely they're gonna pay me back. 1 million divided by about 1,001. So I'm gonna buy about let's buy about 1,000. So I'm gonna buy about 1 million of those bonds. We have about $1 million in cash. Minus our taxes payable. So I'm gonna probably keep at least 500K for taxes and for some liquidity. And I'm gonna add that to my sheet. Where is it? It's preview travel. So we have a preview bond, which is due in 2047. So that's pretty gosh dang liquid. So now we're gonna look for some 2048 bonds, and then I'm pretty much set. 2048. This might be a good one to get into too, potentially. Yeah, let's get into this one then. I don't see any 2048, sadly. So where's this trading for about 1,003. So we should be able to buy 500 of these. It's about $516,000 transaction. And we have quite a bit of money in cash just for our taxes payable. So we may have to pay about $100,000 in tax. So we'll have about almost about $440,000 in liquidity. Right now we're quite invested in some bond layering right now. So I'm hoping that rates stay kind of flat, or if they rise by 2027. I actually might do a bit of bond layering IRL. Like I might do a bit of, especially if rates go up quite high, I might just do a bit of bond layering, or I might even do them now. Like in IRL, I might do by IRL means in real life. I may end up doing some bond layering in real life. I found that pretty interesting. But as of right now, I don't see a good idea in me locking my money in for 30 plus years, and even in corporate bonds, because they don't pay much. If maybe rates go to maybe 5%, but as of right now, we're in 0.25 for Bank of Canada rates. So maybe when that goes to 5%, I may consider doing bonds for my personal self, and maybe consider doing more fixed income. But as of right now, in real life, I'm invested in a lot of. A lot of my money is basically invested in individual stocks, which I'm also going to plan on doing more ETFs. So rates are starting to rise. It's almost the end of 2046. Our annual cash flow, we're making, I haven't checked this in a while, $3,000 in interest from our bank, from our broker, I mean. $110,000 in corporate bond interest, $122 in annual dividend income. We do lesser taxes. We make about $161,000 a year in after-tax income, and we're making about $1.8 million very soon, coming due. And I'm gonna use that $1 million towards buying some more corporate lawn bonds, some more government lawn bonds. If interest rates start hitting like maybe 6 to 7 to 8%, 7 to 8 definitely, and if they're 9, 10, it's a steal. And if they go up to 20, I've never seen them hit 20 in this entire game. Not this entire game, but it's a very, very rare occurrence. It used to happen a lot, but now it doesn't. Yeah, so we should be getting about $1.8 million very, very soon. Once we do, we're going to go ahead and lock in some lawn government bonds, some lawn... How is our corporate bonds doing? Currently big L's, because interest rates are continuing to rise. But good news is I bought some short bonds. We're going to be paid back with back $100, and we're going to be paid some interest along the way. So that's why I'm doing Bond Iron, because I think it's a great way of making some additional income. And I find it kind of interesting. Right now we have about $4 million assets under management. So if you're already asking any question, if I get my calculator out, if you're asking like how much money do I need to retire, well, in order to retire very, very comfortably, I'd say you need about $10 million, because if you make a 5% return on that $10 million, you're making $500K a year. And you could use that, let's just say you only need like maybe $100,000. This is before tax, by the way, consider that. Let's just say it's $500,000 is taxed at 40%. $200,000 will be taxed, so you have about $300,000 after tax, which is quite a lot of money. And then let's just say you only need maybe like $100,000 for living expenditures. That $100,000 will be your negative. You make $200,000, and that $200,000 can be reinvested back into the portfolio. So instead of having 10 million, you have 10,000. You have 10 million and 200,000. So your portfolio will continue to grow. So that's one thing I'm going to be doing when I get older. Is I want to have about $10 million invested in just stocks, ETFs, etc. That way I'm retired nice and comfortably. But like hypothetically, if you want to retire, all you just need is 100%. 1 million. Then that's 5% at 5% a year. You make $50,000 before taxes, and so let's just say that it gets taxed at maybe 30%. So it'll be 150. So it'll be 50,000 minus your 15,000. It'll be about $35,000 you'd have about after tax. And so like that's not really enough to really supplement the average person's income. Like I think the average person, they make like $50,000 like a year, but it helps supplement it. So you could potentially, if you have so like that's one thing I want to hit, is I want to hit at least $1 million assets under management when it comes to my retirement. When it comes to my retirement, I think you need at least $1 million invested. You might be saying, that's crazy. How do I hit 1 million? Well, you can always just, like, it grows. It's compound interest. The more time you have to invest, the more you get. So, like, me being 20, I have tons of time to let the market do work. And so right now I'm at about 50K. So if I do, I'm about 5% towards that 1 million right now, which is quite intimidating, but it's just a bit of a long road. And plus, that's not including pension, your pension from your work that you contribute into. That's not including your CPP. That's not including your old age security, which is OAS in Canada. So in a hypothetical example, you could probably be able to retire, but I would have a bit of money in stocks and bonds, etc., ETFs and such, just to help supplement your income for retirement. Like, that's one thing I'm going to be doing when I get older. I think that's what my parents do, is they have a bit of stocks, just a bit of dividend stocks to help supplement their income. So like, that's one big reason why you want to have a stock portfolio, just to help supplement your income during retirement. Or like I'm doing it right now, is I'm having a bit of my money being supplemented. It's like I make about $1,300 a year, and that's not bad for me. And like all that income I'm making, it's mostly very, very passive in nature. All I just gotta do is just make sure the companies I own are good, etc., etc. So a nice little tidbit. So I'm gonna probably spend a little bit more time on like the financial plan side and try to teach everyone on YouTube and such and help them out. Okay, rates are getting high. I love it. I love it. So $600,000 in bonds. Would that be stupid? No, that would not be stupid. Okay. And are we having any cash flow? Like, what's our cash flow look like? $1.8 million is coming due soon. So I'm gonna go ahead and lock in $600,000 into lawn bonds, or maybe we could do a corporate. Corporate will probably be better. 2060, 2068, 10.8%. I'm looking for a high duration, basically very, 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 very long-term bonds. Lowe's company 2070. That's the longest I've seen so far. So we're gonna go ahead and get $600,000 worth of Lowe's bonds. And then we're going to use our $1.8 million that's maturing very, very soon towards basically buy more bonds. So $680,000. We may have to take out some leverage. Hopefully not. 6, 9, 7. I'm going to buy about 900. I'm going to buy about 1,000 of these. I'm going to use a little bit of leverage. So we're going to borrow about $700,000. We're going to borrow about 75K. No biggie. We're getting $10,000 a year. So in this case, we're making $139K in interest. We're having a bit of annual dividend income of $122,000. We're paying about $7,000 in interest a year off that $75,000 we borrowed. But at the end of the day, we make about $185,000 a year, which we can use that towards basically paying off our loan. And we're having $1.8 million mature soon, which I'm probably going to put in a mix of long bonds, long corporate bonds, like very, very long term. Like if I could find some 2070s, I'll be very happy. And I'll be buying some governments if rates continue to rise. So right now I'm pretty happy. So I want these bonds to come mature ASAP, hopefully. And what are they thinking with the interest rates? Are they easing? No, they're tightening. So if they continue to tighten the interest rates, I'm going to continue buying more and more long bonds. I kind of wish that was convertible. Oh, rates rising. Rates rising. Okay. Did we get our money back? No, we did not. We're in a very high interest rate environment, which I love. I love to see. Bonds paid back in full. Yay, let's go. $400,000 in bonds. Okay, let's find another high duration bond. 2060. Yeah, that's pretty good. Let's look for some higher duration. 2072, General Motors, 11%. I'm looking for a very, very high duration bonds that mature in basically the 2070s. 2071. Darden. 11% interest. That's crazy. Yeah, I'm gonna buy some Darden. Let's buy 400K of this bond. And then after this, I'm gonna go ahead and start exposing myself to more, to maybe some long governments. Then again, it would actually make more sense to if the maturity date is like, let's just say 2060 for the long government bond. It may not make sense because I'm looking for a very, very high amount of the years right now because we want to make as much capital gains as possible because we're locking our money for a long period of time. Worst case scenario, interest rates stay this high forever, and if they go higher, I'm okay with it because I can use my 11% coupons towards buying it at the higher level. I'm okay with it. But it's potential risk that interest rates may rise. 705. What about 500 and let's just do 570 of these. I'm gonna borrow about 401,000. I don't know, we're gonna take out 401,000. We have a wee bit of taxes to pay, but it's alright. We have a bit of liquidity for that. So right now, I think this would be interesting. Ago 2047. We have about 300k coming due by the next year. I think so. Where's our cash flow? Yeah, we have about 1.3 million coming due soon. So I'm gonna go ahead and lock in some long bonds, and I think we're good for corporate. Like we have about yeah. So we have 1 million this preview travel, which is a very, very liquid bond that we bought. So hopefully by 2047 rates are still high. That will be hype. But I didn't want to miss out on the potential of getting some capital appreciation. So we bought a Lowe's bond at 2071, and we bought Darden Restaurants. I think that's how you pronounce it. And two of these are 2071s. So like these are very, very long maturities, and they're paying us a large amount of money. Like these are both about 11%. I'm just gonna say 10% because that's like a bit safe. It's a bit of a safe assumption. So we're making both 10% on these. That's delicious. We're gonna be making interest for days. And so if I look at my income, we're making $170,000 in interest income. 122. This is before tax. After tax, it's 300,000 minus our taxes, $215,000 a year. So we're doing pretty well, and we're getting 1.8 million. So by the end of the year, we should have 1.4 million, which we can put towards buy more long government bonds, buy more long corporate bonds, maybe do a little bit of convertible bonds. It would just be a fun time. I kind of wish I talk a lot. I'm sorry, but I kind of wish that the creator. If you're watching this, I would really appreciate it if you make preferred shares an option, because that'll be kind of interesting to get into. Because then I'll get a little bit stronger, but he's probably not gonna. So our preview bond, we got $1 million. Awesome. Interest rates are still kind of high right now. So maybe if they hit 9, I'll be happy. Ago, we got so we got our preview and we got these two. So as of right now, we have about $1.3 million in cash, so we can buy more government loans, we can buy more corporates. So what is the what's the term on the long? It's 2062. So actually, I feel like hypothetically, if interest rates were to go down, the government bonds wouldn't make us as much capital gains. The corporate bonds will actually make us way more. So it probably makes more sense right now to look for a very, very long-term corporate bonds above 2062. That'll be hype. Okay, 9%. I'm gonna start eating up some more corporates. So we have about 1 million cash. I'm gonna put 1.3. I'm gonna put about 1 million towards a very, very long term. So looking for a very, very long duration. 2060. That's reasonable, but we're looking for above 2062. This one might be good. 2069. If there's any 2070s, I'll be happy. American General, 10% to 2070. If there was super duper duper long term bonds, I'd buy them. That'd be nice. Okay, I think you're the winner so far. I'm looking for very, very long duration bonds, basically. If rates do go up, though, we're in a bit of trouble. So this is 2071. It's going to pay us 10.45%. And I'm not going to take out any leverage with this transaction. We could make a lot more money if we took out leverage and interest rates were to fall. But you don't know when interest rates are going to fall, so it makes sense just to not take out leverage. So I'm going to buy 1 million of this. It's going to pay us 10%. Is there any better alternatives? That's the question. Is there's any paying like 11? Not really. Yeah. Okay, I'm just gonna buy it. 1 million divided by 6 9. So we're gonna buy about 1,400 of these bonds. I'm gonna buy 1,500 of these bonds. That will cost us around 1 million. So now we have $300,000 in cash, which I plans on using towards paying off some of these taxes that we have to do, because we have 43,000 in taxes on ordinary income. We still have our stocks. Our stocks are hurt a lot, so it may make sense to buy the dip on these, especially the ones that got hurt the most. So if I hypothetically look at, I usually look at like the percent drops, because a lot of the times they don't tell you the percent drops, so you have to calculate them. So it's 26.54 minus your 19.76. That's a $6 drop, and so we divide by that by 26.54. That's about a 25% drop in our blue chip income one. So 25% drop in one of them. 25% in the blue chip. So I'm looking for bonds bonds that potentially got hurt a ton. So in this case we got, so this one didn't get hurt a lot. It's 43.10 minus 41.90 divided by 43.10. That's about a 2.7% for our junk. So our junk bonds got hurt by 2%, so it's no biggie. But this is probably our biggest drop yet, the prudent security one. So this actually makes more sense to buy more of this ETF. So it's at 69.48 subtracted by 45.77. Got $23 drop. Divide that by our $69.48 times 100. So if it makes sense to buy the dip on anything in this game, which one's hypothetically the better one to buy the dip on? The one I lost 34% on, the one I lost 25, or the one I lost 2%? That's a rhetorical question. I know the answer. It's definitely the 34. So it makes more sense to buy more of this government bond ETF. So what we're gonna do is we're gonna go ahead and buy the dip. So we have about how much? We don't have any money coming in, sadly. We don't have any money coming in, sadly, from our what's it called? We don't have any money coming in, sadly, from bonds maturing soon. But hopefully these long corporate bonds do well. And I'm gonna reinvest the $280,000 towards more long government bonds. But as of right now, I'm probably just gonna go towards just reinvesting $300,000 back into more of this government bond thing, because this thing, it took a 34% drop, so it's taken a lot. We've lost a lot of money on it, but because it dropped so much, we can lower our cost basis from $69 to maybe $50 at most. Hopefully, we can lower our cost base. So this is the benefits of buying the dip. If it continues to drop, though, we're gonna lose more, but it's all right. Because I think it's a good deal right now. Like, is it a good deal? So you want about 6%. What's their portfolio consist of? I should look into this. 380,000 long government bonds, 44,000 long short government bonds. What's their portfolio consist of? This it's taken a bit of a drop lately. Where is it? Company info. This portfolio. They've bought a bunch of bonds at $61. So me thinking that's actually good. So like potentially if interest rates do drop, this company is going to make bank. So it might be actually a good long-term investment to buy more of this. If they bought in at lower, if they bought at like lower interest rates, I would consider not buying this. But in this case, I'm gonna buy 300,000, keep a little bit for taxes, and keep a little bit for just growing my valuation. I might want to go buy more long bonds too. We're gonna go ahead and buy the dip on it. So we're gonna go ahead and buy 6,000 shares. Let's do that much. So it will cost us around $300,000 to buy that on the dot. So we have 63,000, which is going to be used towards paying back our ordinary income and our year-to-date income tax. So this is how much we owe, 16,000. So we have a little bit of liquidity to pay that back, and we have our cash back. We have our cash flow on our portfolio. So now we have 246,000 in before tax interest, and we have that much dividend income. And we do our bond discount to make us get a bit more cash flow because we bought at discounts. And minus our taxes, and we should have about 201,000 plus our cash. So by the end of 1 year, we should have $264,000 in cash. In which, if I find good deals in the market, if interest rates continue to rise, I'm going to continue buying more. But as of right now, I'm just going to let time play out our investments. So I think I'm really well set up for potential rate drops or potential rate increases. Mainly a rate drop though, because we invested a lot of our money in such. Oh, this is also pretty helpful. So we lowered our cost basis on the prudent shares fund. That's because we bought it at a very low. Bought them when they're beat up a lot, so we got to average down from $69 average cost to 52. So now we have a now if it goes to 52, we break even. And if it before it had to go to 69 or for us to break even. So now because we bought the dip, we have a bit more of a chance of breaking even on this investment. And I saw it as a great attractive valuation. So I'm pretty certain that we're going to make money off this government bond index thing. And if I maybe receive more money, which is pretty unlikely, I may buy more of this because this has fallen quite a bit. And then my last thing I'm going to buy is this high income thing because I've lost like 2% on this. So hypothetically, you want to buy the stocks that have dipped the most. But of course, you want to research the company and make sure like they're not down there for a reason. Like this the prudent government securities fund, this might have actually been hurt a lot. So it might have not made sense for us to buy the dip, especially if they had like, and let's just say they locked in government bonds at 4% on the long, their portfolio would be crushed, and they would probably stay crushed for a while, and so it might not be a good investment. So a lot of the times, they're fundamentally down there for a reason, but some of the times, investors like me, we're just discounting the portfolio a lot. We're just discounting the stock a lot. So a lot of times, you gotta look at like the fundamentals of a company, and if the fundamentals are still solid on the company, it might make hypothetical sense to buy the stock. So like, that's what I usually try to look at is one thing for Manulife, for example. Manulife dipped a while ago, and I decided to buy the dip on that. And I did really well on it because the fundamentals didn't change. The story changed a little bit, but they ended up winning that lawsuit, so I was pretty happy with it. So as of right now, we're just going to go ahead and let time play out. Like I said, investing takes patience. So we're going to use our $300,000 a year, just buy more bonds at higher rates, or continue to average down our portfolio. How's our convertible bonds doing? So this long bond we are doing is doing pretty well. Kelly ain't doing so well, I think. So if we look at Carl's Jr., $28. I'm just gonna go and clear this. Champion's at 11. This company is at 52, so it's almost at like 130, but still got a bit of a ways to go. So the convertible bonds, they're not doing so well at the moment. They're doing alright though, which I'm happy with. So we're just going to go in and wait a bit. Wait a bit for our investments to play out. Rates are starting to have a bit of a downward trend though, so that's kind of got me worried. So I'm not going to be able to really use my cash flow much towards investing much. Oh, they're starting to flatten out. Thank you. So hopefully I can buy more at like lower levels. And so it dropped a little bit, but it's all right. So I'm just going to let our investments play out. Hopefully rates will continue to rise. I was thinking about maybe taking leverage, but then I saw it flying out, so I'm like, maybe it's not a good idea to take out some leverage and buy long bonds, maybe. So as of right now, I'm just gonna build up my cash reserves and then go ahead and buy more bonds at a higher level. I like to have some liquidity right now. So if I look at things, we don't have a lot of liquidity right now. So if I like to think of this, as I like to look at the valuation of my thing, so it's 172. We have this much in liquidity. If we divide it by our total assets of 4848277, right now we have about 3% in cash, I believe. So 3% of our entire portfolio is in cash. So that's potentially a good thing to add. 3% cash. So I learned that like you want to have typically 5 to 10% in cash, 5% on the low, but sometimes you can have a lot less than that. I usually tend to have a lot less than that. Right now, with my real stocks, I have about 4.4% in cash because as of right now, I think the market's a bit overvalued. IRL. We have about 1.08 million in stocks, so 1803077. I like to do this every so often. Just look at like my portfolio. Look at the weigh-in. So in this case, we have about 37.19% in equities. And then the rest, which will be 2885082 divided by our 4.8 million. We have this much in long bonds. Round that up. No, just keep it. So this is in corporate bonds. So this is potentially good to look at. Is right now we don't have a lot of liquidity. We have 3% about in cash. So if I make this like a little bit bigger potentially, we have about 3% of our entire portfolio in cash, 39% in equities, 59% in corporate bonds. So if we look at that, it's basically, of course, our equities will be a lot higher because we're that also includes our corporate bonds that we bought. But in this case, if we look at it, it's like we're highly skeptical right now to interest rate risk. That's our main risk when it comes to our portfolio right now. Our main risk when it comes to the portfolio is interest rate risk. And then right here is also market risk. So, and then cash, I'm going to say like there's just inflation risk. Or as I like to say, sometimes it's opportunity cost. So there's an opportunity cost right now. We're keeping 3% of my portfolio in cash. I could have that all invested and I could receive way more than I'm receiving right now. So as portfolio management, we are heavily exposed to interest rate risk right now. That's just mainly the problem about buying bonds. You have interest rate risk. Like corporate bonds, this corporate bonds right here, we're heavily rated to like interest rate risk right now because if interest rates rise, it hurts the value of our bonds. Equities, the bond funds we have, hypothetically, interest rates might be down a lot, but the market, maybe their investments might not be doing as well, or investors just hate the company or they hate the ETF in general. So that's market risk. So these are potentially the big amount of risk that we have taken on when it comes to our portfolio. Is we just take we take on you usually take on market risk with equities. There is a bit of market risk with bonds, but not as much as equities, in my opinion. Because if we look at our bond portfolio, we've actually taken a bit of risk. Like, we've taken a bit of a valuation drive. And I'm pretty sure, I don't know if you can look at the chart of, let's look at my chart. So, like, we're mostly flat. We've been growing a little bit, though, every now and then. But we're mostly flat. Whereas with stocks, it goes up and down. So there's way more market risk with equities than with corporate bonds in this game. So I'm hoping that over the long term, we can manage our risk. So right now I'm mainly linked to market risk and interest rate risk. And we also have inflation risk, which there's no inflation in this game. But I like to think of just keeping cash right now as an opportunity cost. We could have invested it somewhere else and made more money. So I'm just going to keep that up. Hopefully it's not too distracted. So right now, interest rates are kind of flat. So the good news about us holding this bond portfolio is eventually when these bonds come due, we're gonna be paid back 100. So like this is the one thing I like about having bonds is, and one reason why they're actually one of the most least risky assets you can buy out there. If I wait until 2053, Fort James Group, they're gonna pay me back $100. So I bought in at $80. I'm gonna make about 20 bucks. That's almost guaranteed. The company can still go bankrupt. So that's another risk that we could potentially be taking on right now is default risk. Like if these companies go bankrupt, then I'm in a lot of trouble. But most of these companies, they're triple B to A, to double A, to triple A in some cases. So in my opinion, default risk is very, very low when you have A companies and B companies. But once you start getting to the double Bs and the Cs, that's when I really consider default risk a potential opportunity. But default risk is still here. So with our bond portfolio, our two main risks are interest rate risk and default risk. So if interest rates go up, that hurts the value of our bond. If the companies default on their pledge of, hey, we're going to pay you back by 2071, 2051, 2052, etc., then that's potentially a big, big risk because the company goes bankrupt. Well, as with, if I want to completely get rid of the default risk, I could hypothetically just buy government bonds, which government, it can still go bankrupt, but it's a lot lower of a chance. So if I see potentially a lot of companies going bankrupt in this game, like I did with like my last series, I just went heavily into government debt because I saw companies go bankrupt left, right, and center. So I saw default risk as a potential issue. But right now the market's been perfectly fine. I haven't seen anything really happen. Like right now with COVID and stuff happening, default risk for some companies is actually a real thing. Because, for example, for Cineplex, that one Cineplex bond I bought, it's a convertible. There's still default risk with that bond I bought because they've taken on a lot of debt due to the coronavirus. Because they've been shut down their business. They're not making any income. They're not making any revenue. So a nice little tidbit. Nice little thing. So now we have 184,000. So this is going to be off by like a lot. So I might as well get rid of it. But it's a good idea to keep in mind. This is how much I have. Every once in a while I might update it. And maybe I might have like, for example, I might have like a portfolio. My portfolio might be, I want 5% in cash. I want maybe 30% in equities, and I want the rest, which would be 35%, and then 65% in bonds. So in this case, I'm in this case, if you're doing like your portfolio management thing. Right now, currently, I'm underweight corporate bonds, I'm overweight equities, and I'm underweight cash. So as of right now, in order to bring my account back to balance on the portfolio, I would need to bring up my calculator. And let's say I'm going to look at my equity all of the times, which is 5 million. And then I'll just do 0.05. So in this case, I need 250,000 0.99 in cash. In equities, I do the 5 million. And I do that by 30%. So in this hypothetical example, I would have to have about $1.5 million in equities. In this case, I'm overweight by X amount. So if I do 1, 8, 2, 9, 3, 9, 4 minus the 1.5 million, I'm just gonna say 1.5. It's actually a little bit above that. I would need to sell about $329,000 worth of equities to bring back my portfolio way into 30% equities. Because as of right now, I have about 38, 39% equities, or 37. I'm not too sure, don't really feel like doing the math on that. But as of right now, I'm overweight equities. And if I want to bring back my way into bonds, like this is the balance I should have. So I should sell about $300,000 worth of equities if I want to keep to the specific mix of assets. Like if I want to have 5% cash, 30% equities, 65% bonds. I've ended up doing a portfolio series where I actually ended up doing that last series where I did a mix of 50-50. I did 50% bonds, 50% stock. And I just crushed it because every time I saw a good deal with bonds, I overweight bonds temporarily and I underweight stocks temporarily. You know, I just reinvested the profit back into more stocks and brought myself back to balance. Some people have a little bit of trouble with this though, so I thought I might as well cover it. So if it's 5001980 and that, what if I want to have 65% bonds? Well, I would need to have a balance of 3,251,287. So in this case, we have about 2 point that much. So I should have actually kept that number. My bad. If we subtract that by our current balance of 29,088,405, we actually have to bring that up by 262,000. So we have to bring down our equities by about 360,000. We have to bring back up our bonds by about 262,000, and we have to bring up our cash by about almost 100,000. So that's how you bring back our balance to these nice like round numbers. But I'm just gonna get rid of that. And I'm just gonna go a bit overweight things, and I'm not even gonna keep much cash in this game because I don't see good opportunities with cash at the moment. It's an opportunity cost, like I say. You could be invested somewhere else. Like basically the definition of opportunity cost. I meant to pause the game, bro. I might as well save it. We're almost near retirement in the first place. Okay, I paused it. So I think this is one of the first things you learn in economics class is the concept of opportunity cost. So in microeconomic theory, opportunity cost is the loss of the benefit you would have been enjoyed at the best alternative. So this is something that you always risk, in my opinion, when it comes to investments. Oh, if I would have invested my money in Apple a year ago, I would have been so much better off than if I bought utility stock. Well, it's an opportunity cost because there's potential. It's just the cost of doing something else. But like right now, there's an opportunity cost with me sitting down and doing YouTube. I could be reading books. I could be learning how to get better investments. I could be watching movies. I could be talking with friends. But as of right now, I decided my best thing for my time right now is to do YouTube and try to grow my brand. I decided to grow up my and just somewhat teach some people my things and my knowledge. So I find that pretty interesting. So that's an opportunity cost. Me going in here on YouTube, it's a time. It takes time. Like so far, I've been live for 2.5 hours. That time could have been spent elsewhere, but as of right now, I'm pretty happy with my YouTube. So I'm thinking it's worth my opportunity. I could be doing it somewhere else though, but whatever. Oh damn, something happened with our portfolio. We boomed. I think it's because rates fell. Yeah, rates fell a lot. So I'm pretty happy that I didn't keep a lot of cash. kept a lot of corporate bonds. So our corporate bonds are worth a lot now. So we bought high duration corporate bonds, and which I'm really, really happy about. We're hype. I should have bought a bit more corporate. Oh yeah, they took a bit of a tank. These took a little bit of a tank, but they're probably the tank down a little bit more. So I might as well. I'm gonna buy maybe $200,000 just worth of government lawn bonds at 6%, which isn't bad. Hopefully rates fall a little bit more, and then we can make a little bit extra money. Worst case scenario, we have 200,000 locked in at 6%. It's not the end of the world. It's like a small amount of control. If we do that, 200,000, divide that by our 5. No, I want to do this. 200,000 divide by 54000. So we about 5.4 million. So is it the end of the world if I invest $200,000 at 6.7%? Not really. If we have about that'll be 3.7 of our entire portfolio lost potentially. But I'm okay with losing that much. I'm okay with just locking my money into a lawn bond. It's just for a little bit extra income potentially. So I'm gonna buy about 260 of these. Why not? I'll take a little bit of leverage. Yeah, I'll borrow 12,000. It's no big deal. And interest expense could potentially be tax deductible. So in this case, we're making 11K a year in government bond interest, 246K in government corporate, and that much in dividends. Minus our bond discount. Oh no, actually add that because we bought a lot of them at a discount. Subtract our tax. We have about 307,000. Our interest is 995 for the 12,000 we borrowed. So we could actually theoretically look at that. So 995, and we borrowed about 12,000. Oh my bad, it's the other way around. I don't know. I'm pretty sure it's 995 divided by. Yeah, so right now we're paying about 8% interest, which that's not a big deal. If interest rates continue to fall, I'm okay with it. So if we look at it, I'm paid about 7.5% on the variable, and we locked our money in on the bond at how much did we lock in the long bond at? About 6.7%. So if rates continue to fall, it might actually be beneficial just to keep that and just pay off our loan over the time. Yeah, that's all right. So as of right now, we don't have any cash. It's misleading. We don't have any cash at the moment. We have a lot of stocks. So it's probably a good idea to look at my my stocks. And let's see whether or not it was a good idea for me to buy the dip. Yeah, we broke even. So if I had $69 cost basis, we actually broke even on this now. So it was actually a good idea for me to buy the dip on the government security bond thing. So I'm pretty hype. It actually might make more sense to buy a bit more of this, but it's not even that down that much, so it's not even that big of a deal. With that much in that, we have $200,000 in. So this is like our gov. I'm just gonna do gov of 201, and we have about corp of 33. There we go. And I'm gonna get rid of all this. We understand the risk of what we get onto. I'm just gonna update my bond portfolio. So we have a lawn bond of 2062. It's just, I like having a good picture of what my things are. So our gov bond is 2062. We have a Lowe's bond at 10%. We got a Fort James bond. We got this. We got that. We got this. We got Darden. We got America General Insurance. Say American 2071. So if we look at this bond portfolio, is actually doing pretty well. So we're gonna wait for rates to hopefully drop a little bit more. If they decide to go back up, it's not really the end of the world. But we do have like almost no cash. So my main objective right now is just gonna be to use this taxable income and then minus for taxes, 301. We're just gonna use this $301,000 at the end of every year. We're gonna make about 227,000 at the end of the 1 year from now. We're just gonna build up our cash, and then if I find a good opportunity, I'm gonna use that cash towards buying more bonds. That's called liquidity, my dude. Liquidity is a great thing. It's always great having liquidity. It's like a lot of people like to call it dry powder, because like if you think about it, if you find a good opportunity in the market, and if you don't have cash, because cash is the most safe investment out there that I can think of, but it doesn't go anywhere. It's a very, very boring investment. It doesn't make anything. In this case, it makes me, if I look into it, I haven't looked into this in a while, but as of right now, if we look at interest rates, my broker is paying me about 0.50%. That's almost nothing. So it makes more sense to do bond ladder in this game. That's why I'm doing it every once in a while. But it's still nice having cash, because when you have cash, you can say, look at this amazing deal I found, I'm going into it. So that's why I'm more of a cash kind of guy now. I like having cash in my personal investments. I like having cash in this game, because you can use that cash towards buying opportunities. Right now, our government loan bonds made us 80,000. We made we made a bunch of money off of the Lowe's bonds. Awesome. Do we have any capital losses we took on? No. Just all gains from now on. We're doing so well. We're doing so well. I won't say we're doing too well. The short rate continues to fall, How much are we borrowing? How much is our borrowing right now? It's, where is it? 3.25%. And remember last time, when we bought that government bond, it's paying us about 7. So there's a big spread. So it is actually a good idea to borrow money in that hypothetical example. So that was hype. Now we have no debt. Pretty great, bro. We're making 306 after tax. I'm gonna go ahead and bring up my liquidity. We're gonna go ahead and maybe exit all those long bonds, especially if rates are gonna go back up. If rates are gonna stay low for a while, it might make sense for me just to keep this. But as of right now, I see it's a good opportunity just to exit all the long bonds. So I'm sorry, government lawn bond. I love you, but you gotta go. I would rather have $100,000 profit cash than. So we're gonna have about 310,000. So we're gonna take home some giant capital gains. We have $100,000 realized capital gain so far from that lawn bond. It's gonna get much higher than that. We might actually owe millions of dollars in capital gains. A $500,000 realized gain on the Lowe's bond. How much is the Lowe's bond trading at? It's trading at 124. So this is quite high. I'm gonna go ahead and exit out of it. We're gonna go ahead and sell our Lowe's bond. 1,000 bonds. Make about 1.2 million. No biggie. Pretty hype. American General Insurance. A $100,000 gain. Trading at 124 right now. We have a long time. We could theoretically keep this into 2071, but right now I'd rather take the gain and just keep it in cash. 1,500, 1.8 million. That's pretty golden, and we'll receive 10,000 accrued interest. So accrued interest is something that I still don't get much of. Accrued interest, but I found it kind of interesting. It's a little bit hard to calculate, but basically, if you hold a bond for, like, for example, until let's just say it pays in like May 30th, for example, and you sell your bond on May 20th, well, it's basically going to pay you for the 20 days that you hold the bond. Let's just say you bought May 1st, you hold it until May 20th, it's going to pay you that 19 days you held the bond for. Of course, there's going to be a bit of time for it to settle, so it might be actually like 17 days worth of interest. But basically, people that buy bonds, they have to pay accrued interest. So I had to pay like a little bit of accrued interest on my Cineplex bond. So we're going to take our Darden restaurants. I actually might keep that for just some income. But then again, it's probably makes more sense just to kick a capital gain on it. A good old, how much money? 570 of these. About 700,000. Not bad. So this is like some big money, my dudes. This bond right here. So I might as well just dump all my convertible bonds and just go into bond ladder for now, because what might make sense just to have a little bit of bonds just for some income, for some cash flow. I'm probably gonna keep those convertibles just because. So as of right now, we're making $151,000 in dividend income, $20,000 in corporate bond interest. So we reduced our corporate bond interest by like a lot by selling those bonds. Yeah, so as of right now, we took on a ton of capital gains. We have about 1.7 million in capital gains, and we owe about $410,000 in tax. So hypothetically, if I had any losses of like 400,000 or $1.7 million loss on these shares that I owned, I would hypothetically take that loss. Maybe it may make sense to take that loss, but as of right now, we're basically riding the gravy train. We're making bank. So we sold out of all these bonds basically. So all we have is convertible bonds now. So as of right now, interest rates are low in this game. They're probably gonna stay low for a little bit, maybe like a year or two tops. So with that in consideration, it might not make sense to buy these bonds right here, because if you look at them, they're probably all expensive. 110, 113, because interest rates are low and they issued them at higher levels, so they're worth a lot more. So some of these might make sense to buy, like this one right here, 2053, but you're locking your money in for I think a long period of time. I should re-update the year. It's 2048 right now. So you're locking your money in for a fair amount of time in order to receive that. So I'm going to probably try to look for a where is it? 2049 bonds, maybe, if there are any. 2049 right here. So this one wouldn't be bad. It's paying 3.24. $3. I like to think of this as dollars. It's going to pay me $3.24. That's the yield on it. And I usually look at the coupon and the yield to maturity. So if the yield to maturity is bigger than the coupon, typically it's so like for example, if you look at a discount bond, which is trading below 100, where is it? Right here. And you can see that the coupon is $2.75 for every $100, or it'll be $27.50 for every 1,000, which is the minimum. So that's a little bit misleading. So that's to say you put $1,000 in this bond, you make $27.50. But as of right now, it's got a $3 yield to maturity because it's trading at a bit of a discount. Well, it's vice versa for this bond right here. It pays a 8% coupon, but because interest rates have fallen a lot, the price of the bond is worth a lot more. So that's why it's $115, and that is also why the yield to maturity is 6%, and it's for a long period of time. So that's usually why I like to do in this game, is I like to think of three main things when I'm playing this game. I like to think of the coupon. So if the coupon is high, it typically means you make a lot of money, and therefore it's less volatile, because if you buy a low coupon bond, you're not making much. And so if interest rates rise, it's going to be very, very durational risk. So duration risk, basically, it's going to fall in price a lot faster than a high coupon bond. So in this case, like the higher the coupon, typically the better. But also typically the higher the price you have to pay. So I like to think of three things. I like to think of the coupon for like the income that you would make if you bought it at par. So I don't really think of the coupon. I think of the coupon as a comparison. And I also like to think of the yield to maturity. This is my favorite thing to think about, because it's basically, if the yield to maturity, if I get it up real quick on Google, I don't know 100% of it, but I'm pretty sure if you reinvest your money, it's just basically if you hold the bond into maturity, how much you will make. So it's not bad. So it's about 7% a year. If I were to buy this bond into 2058, I'll make about 7% a year. But you also got to consider the market price. So in this case, I'm paying $10. So in that case, I like to think of it as 10%. So in this case, the first year I buy it, I'll make about 7%. and I paid 10% above for that, so I paid 1.10. So in that case, after my second year, I would have 1.03, and then after my second year, I would hypothetically make a profit on this bond. But they also don't have in this game the call date. I'm pretty sure they have call dates in this game too, so like that makes it a little bit tricky, or at least they have that in real life. So if we go to buy, there's call provisions. So in this case, there's a call provision at 105. So like if the call provision is at 105, it's all right. But in that case, I could lose $5. But it's at 2049, so it's currently 2048. So if the company has extra money and they just decide, hey, we're gonna go ahead and call the bond at 105, and I paid $110 for it, or 120, I could hypothetically lose money because of the call provision. Or the call provision might actually make sense if you're looking for bonds that are trading below 100. So if you look over here, if the call provision's at 105 or 100, I'm pretty sure it has to be at least 100. Then basically, I actually like that. I like having the call provision. That's one big reason why I like looking for bonds that are trading below 100, because worst case scenario gets called away, you still make money. That's what I like thinking about also with preferred shares. Like, I'm pretty sure with my preferred shares I have, my IRL preferred shares that I bought, I did a bit of an analysis on the Fortis preferred shares, because Fortis is one of my biggest holdings. So if I go over to portfolio 2, my Series G analysis, the call date, or aka the redemption date for my preferred shares, is 2023. So I'm making, for 2020, I bought it about halfway throughout the year, so I divide that by 2, I guess. So I make about 7% returns into 2023. And by 2023, they're like, hey, we have extra money, or hey, we found a bond that hypothetically pays us less than. So the payment for Fortis is based on the par, which is 4.4%. Let's just say hypothetically Fortis finds a bond for 3%. They may actually end up calling this preferred share away, and by 2023 they might call the preferred share away. And if I paid $25 for it, I might break even. But I'm also like also made a little bit of income along the way. But if I trade a bit above par and they call it away at a lower level than the par rate, I'm a little bit sad. But in that case, I get 4.4%. But by worst case scenario, they call me. So like I did this as my best return scenario. They call me at par by 2023. I make $25 because $25 is the par rate for preferred shares, at least for most of them. And the price I paid was $14. So I'm thinking of that as a minimum valuation. The minimum valuation for this preferred share should be at $25. So worst comes to worst, the company says, I think we want to reduce our leverage. They will go ahead and call away this preferred share at $25 or redeem it at $25. I make $25 minus the 14, make a nice juicy capital gain of $300. And I also but worst case scenario, let's just say a yield stay at 0.376% for the 5-year. So the 5-year government bond in Canada. I'm pretty sure it's higher. So it's going to lock in at a higher yield. Yeah, it's 0.957. And when I did this analysis last year when there was a lot of fears about inflation and people were buying bonds because they were safe, and a lot of people are dumping 5-year bonds, I guess, now because they're scared about inflation. So why would you want to lock in your money at 0.3% or almost 1% a year when inflation is 2% and it's going to eat away all your money? So this is IRO. So with my analysis, worst case scenario is that rates stay at 0.376. It gets locked in, etc. I make 4.24%. But it will hypothetically be a lot higher than that because they actually pay you 0.376 plus about, I think, 2.13% spread. So I should hypothetically redo this modeling. So I might be making about not 7%, but maybe 5-6% a year. So I'm happy with a 5-6% dividend every year. But like I'm hoping that eventually they do call the share. So that's a nice little rant. But yeah, so like I usually look at three things. I look at the coupon, I look at the yield to maturity, I look at the market price. Oh, and then there's four. I look at the year due. So I like to think of it as liquidity. Like like with bond laddering, I look at like the current year. The current year in this game is 2048. You're looking for bonds that, if you want to keep a lot of liquidity, like you want to keep basically near cash, you want to buy bonds that are near 2050, for example. That's 2 years out. I like to picture it. Whereas if you keep your money in for 2067, so that'll be 2067 minus 2048. That'll be about 19 years. Are you willing to lock your money in for 19 years for 6%? Especially at these low interest rates? Yeah, maybe if you need the income, but if you want more, hey, maybe it might make more sense to wait until rates maybe go up, and then that would make the value of the bond fall, and then your yield would go up. So I'm pretty hyped. So as of right now, I'm just gonna keep cash, or so in this case we owe in this game $410,000 in tax. So I'm gonna put about $3 million to work towards bond laddering right now, or just buying convertible bonds. So as of right now, I'm gonna picture things better. So I'm looking for some 2049, some 2050s, because it's currently 2048. So I'm looking for some nice bond ladderings. So right now this will be good because it's paying 6%. So it's paying me $6.92 per every $100, and I'm paying $3. So my first year I break even, and then the second year I make $6. So in this hypothetical example, I pay let's just say it's $6.92. This is what I'm thinking in my head whenever I do this bond math. I'm sorry, but it's paying $6.92 a year. I times that by 2 because it's paying until 2050. So this is approximately, it'll be a little bit less than this because it's a different month, you know? Like it's currently February, January, February, March, April, May, June, July, August. So it's probably like halfway throughout the year. So I'll probably make a little bit less than this, maybe $10. I don't know. But Publix, where is it? Publix, there we go. But I like to think of it like that. I'm making $13, and then if I subtract that by $3.29, that's the amount I have to pay for the premium. Hypothetically, for every $100, I'm making $10. So that's about a 10% return. That's 10% for 2 years. Divided by 2. I think my actual return would be 5.2%, including the cost I paid. I'm pretty sure. So this is how I think of it. So in this case, I'm going to buy a little bit of Publix. So what I'm willing to do, like I said before, is I'm willing to put $3 million. So my budget's $3 million. So maybe I can put that, let's just say I want to put that into like 5 bonds. So $3 million divided by 5. I'm going to buy $600,000 increments. So I'll put $600,000 into every bond right now, and we're gonna buy 5 of them. So I'm gonna buy Publix bond for this, and my budget is $600,000 in this game, and it's currently trading at 103. So in this case, I do the thousands because it's a little bit misleading to do 103. So I'm gonna do 103, 103.3. So we should be able to buy. I'm gonna do 581. So this should be around 600,000, 601,000. So it's a little bit of a budget because I decided to buy 1 extra, and because it's might have got the math a little bit wrong. But hey, we got almost spot on. So now we got our first bond, Publix. So in this case, I'm gonna do the laddering thing on my on the notepad. So we got Publix, or whatever. I probably spelled it wrong, but it's into 2050. So if I look at the current year, it's currently 2058, so it's in about 2 years we're going to be paying 600,000, and while we wait for that 600,000 to come due, we're going to be receiving a little bit of income. So in that case, the 600,000 we invested, we receive about 77,000. So that Publix bond is going to pay us some nice little interest while we wait for our money to become due. There is a problem with this ladder. It's not very liquid, but that's the benefit of buying shorter term bonds is by 2050 we're going to be making about 600,000. That's assuming no default risk. So this company, I bought it's in the A, it's in the B bond area. So in this game, it's pretty likely to pay me back. Well, if I go into the triple B, it's still pretty likely, but double B, and it's pushing it, B, etc., they're pretty unlikely. So I found that kind of interesting. So I'm assuming no default risk. I'm assuming they're going to pay me my $600,000 right now. Oh, no, not right now, in 2 years. So I'm looking for a 2049 bond right now, just to keep, just for 1 year's of income. And maybe a 2051. We found a 2051 right here. It's going to be, like I said, with my brain, I think $6.94 times 3, because it's for 3 years approximately, $20, and we're paying about $3.96, about $16, divide that by 3. This is how much we should make every year. Should. That's the actual dollar amount per $100. So I found that kind of interesting. So we're going to go ahead. This is a 2051 bond, I'm pretty sure, right? So if we go over here, yep, 2051, tire. So in this case, I'm going to go and get my calculator out. We're going to do 600,000, my bad, 600,000 divided by, I gotta do timestamps too, that's also one thing I was probably going to do tomorrow. 600,000, 1046. So you see, like the last price, it was 1046. I think 1004. So that's $40 and then 6 for 1046. But if you see the ask is completely different. So I'm actually using the last price. So that's why my math is probably a little bit off. It's because the ask is 104.90, so it'll be 150. So I'm about $4 off approximately. But hey, I buy a little bit more bonds, so this will be a little bit above budget. Yeah, it's a little bit above, so it's no biggie. If I wanted to get it exactly correct, I would probably have to do the asks. So we bought another bond. We have Taiwan. And this is for 2051. So we have some nice little liquidity now. Okay, I'm gonna start looking for some 2049s right here. Butch and Lomb, $3. So I'm thinking $3 and 26. For every $100, I'm gonna make $3.26 minus my premium of $1.62. We're gonna make about $1.64 in profit. And if we divide that by 100, we're gonna make about 1.64%. So it's not really that good, but we're still gonna make some profit. So that's why I like to think about in my head. This bond isn't all that great because we're gonna make 1.64% for 1 year, but that's still something. It's better than my broker paying me 0.5. Like if I look at the current rate of my broker in this game is paying me 0.28%. That's pathetic. So if I do 1.61%, subtract that by 0.28, we make about 1.3% profit spread. So that's why I say cash has an opportunity cost. But we could potentially find a better bond, because in this case it's 2049 or whatever. At 2049, but we would make about 1.6%. Maybe we could find a better one if we actually look. Like right here, this is actually a worse bond, because we're paying $3.68, and we're paying about $4 above, and it's only going to pay us a year's worth of income. So in this case, we'd actually lose money off this bond. Let's just do a quick calculation. So in this case, it's 2049 comes due. We're paying $3.68. We're getting $3.68 from it. If we subtract that by $4.94, we're losing about 1.26%. So if this bond was trading at par, I would say it's arguably better, but it's not as good. So I'm gonna stick with my gut and say let's just do that Borel. Do this bond over here. Yeah, this bond is better. So let's do 600,000. Right, or did we buy it? I don't think we did. Did we? No, we have a 2050, 2051. That's why I like to have this little thing. Where is it? 2049. This one. Let's go and buy it. $600,000 divided by our 10. Here, let's actually do the math correct. It would be 10194 or something. There. So we should be able to buy 588 of them. And it's going to be a little bit off because we can't buy 0.58 of a bond. So let's just round it up. It's going to be a little bit above budget. I'm okay with it. So it's a little bit above budget, like $400. Whereas if we did no, and we bought 588, it would be about $600, about $600 below budget. So I'm gonna go a bit above budget. In this game, I prefer to go above budget than below. Depends how much money I have. In this case, I got plenty of money, so I'd rather go above budget. That's just my personal opinion. Okay, we have a NER bond, which is great. We have a Bush and Lamb bond, so I'm going to do that. We have a Bush, and it's going to pay me to 2049, and we're going to make about 1.62% profit. That's good to consider. Publix, it might pay us a little bit more than that. I could probably, if I wanted to waste a lot of my time, I could calculate the actual profit I would make, but like, yeah, this is just assuming that this company has like no default risk. If it goes bankrupt, then that 1.62%, I'd rather have that in my broker's account because it's risk-free. Fun. So we have 3 bonds so far. We're halfway done. I want to probably look for another 2049 or another 2050. So if we can find a 2050, that'll be ideal. Let's start looking for a little bit less creditworthy. 2051. So this is the yield to maturity is 0, so it's gonna make us nothing. So there's no sense in buying that. 2051, 4.2. So this bond would be good. National Grocer, because it's gonna pay me about $4.2 a year for every $100 invested. And if we times that by 4.2, I'm also assuming with this that I'm assuming it's every year. Like there's months I should be concerned, but it's also a little bit difficult to do the months because that just bogs down my time in my opinion. So 4.2, it's currently 2048. So if we do that times 3, we get $12. Subtract our 85 cents we overpaid for the bond. Bam, there we go. I'm gonna buy more of this. So we buy $600,000 worth of this bond. It's a little bit less it's a little bit less liquid because it's for 2051. So I'm gonna start looking for some 2050 bonds and maybe some 2049s. 600,000 divided by 101.0. So it'd be about 594. I'm gonna round this. I'm gonna do 600. So we pay a little bit above that. So right, 600,000. So in this case, we have about $3.5 million in bonds. We have our National Grocery at 2051. So let's say National 2051. So right now we have very, very liquid Publix bond, which is 2050. Should actually do this better then. Publix is actually 2050. Yeah, we got that. Taiwan is 2051. Bush and Lamb, yeah, it's 24. Okay, we got that correct. Yep. So we're 4. I want to look for maybe a 2050 or a 20. Let's look for some 2049s if possible. Butch and Long, we already bought that. Like, this is one of the big reasons why I didn't want to waste my time to a certain degree on this. This is a really good one. Southwest Airlines. 600,000. I'm just gonna rush this a little bit. I don't have to really do that much. I know I'm gonna make a profit on this bond, or it's highly likely. 1035. So I'm gonna buy about 580. About 600,000. We got that. Pay about $300 above budget. Southwest, which is 2050 bond, right? Southwest. And then that's for 2050. So, like, the benefit about me doing this is it spreads across my interest rate risk. I'm buying some longer term, I'm buying some midterm bonds, some short term. I'm not really buying much midterm though. I'm mainly buying short term bonds, but I'm just keeping that for liquidity. And then we have 1, 2, 3, 4, 5. So I'm gonna look for maybe a 2049 bond, and then we're set. And that's about it. And hopefully by 2050, 2051, interest rates are higher. If they're not, we're in a little bit of trouble. 2052. Yeah, like why would I lock my money in for current 2066 minus that'll be 2048. Why would I lock my money in for 18 years at 7% when I can get a much shorter term bond? So that's why I'm more of a fan of having liquidity in this game. At least in this game. I may end up buying a bond IRL. So this is my best bond I could find at the moment. It's about 2 years coupons. If I look for some triple Bs. What does a star means? I forgot what that means. That's interesting. Apparently these are the stars being apparently they're convertible. Damn. I did not know that. So we'll look for some 2050, 4.9% for 2 years. I don't really know. 10% to 2066. Some of these may actually be worth it, because like this one is actually a pretty good bond. Like if we look at it, it's pay me $10.62 every year. Even it being at a very, very, very low interest rate environment, this bond may actually be worth it. It's trading a bit above. It's trading at a huge discount, a huge premium. It's $10.62 I'm making in a year, and it's into 2066. So that's actually a bit better to consider. 2066 minus 2048. So this one may have to be a good long-term bond. So it's 18 years. 18 years of payments, and 62. So we're making about 191, and we're paying at $18 and $86 premium. So we're making about $172 of our $100. So if we did that by 100, we make about 1.7% a year. Divided by our 18 years, our return would actually be 9.5% a year after our cost. So we should be able to make 9.5% a year on this bond. That's pretty hype, not gonna lie. So how much money do we have in liquidity? We have, no, actually a lot. So like this is our problem. We're gonna be locking about $600,000 away into about a 2060 bond. So this bond's not bad if rates stay flat, but if they rise, it's gonna hurt the value of our bond by like a lot. But we'll be able to buy more of it. It's a high coupon bond. That's one thing I like about it. So like the duration risk will actually be pretty low. Plus I just want to play around with it. So it's 1194. So about 502 of these bonds. 503, why not? So it's about $601,000. It's gonna pay us for a while. I did not know why that did that. So basically, this has a very, very high duration risk, so that's why I bought $600,000 of it. I would have bought more, hypothetically, if I knew interest rates were going to stay flat. But I know they're probably going to rise, and that's going to hurt the value of my bond. So this is Skyline. The good news about it, though, it's 2066. No, the good news about it, it's a high coupon, so it should be a little bit less should be a little bit less volatile to interest rate increases, because I'm going to be making 10% a year. It's a high coupon, which I like. So it should be a fine bond for us. Fine bond. You know, it's worth paying the premium, especially if what's the call date on that bond? Call date is 2057. So if I do 2057 minus the 2048, right? That gives us about 9 years of payments. We're making about, I think, $10.62 minus our $18. I'm gonna do 19, round it. So we're making about $76 over that period. So we're still gonna make a profit off this bond if it gets called, hypothetically. Interesting. Okay, so we're so close to retirement. 4 more years. So I think it's about time to chill. Took a bit of a dip. It's probably because of our taxes. Right? Ouch. Yeah, we don't have much towards paying our tax bill. We actually may have to borrow $100,000 from the bank. Not the end of the world. So we may have another big tax bill come in due, which sucks. Markets plunge. Oh damn, that company's booming. What's that one company? The Mato? Oh, look at this. We bought the convertible bond at 82. It's worth 150 now. So that company is just booming. So that company we bought right here, pretty hyped. Gonna go ahead and exit out of that convertible and just pay our taxes with it. Thank you very much. That company I can't pronounce. Let's sell about 150 of it. We're gonna make about 223,000. We bought about $150,000 worth of it, I think. So that's pretty good. Thank you, Mr. Convertible Bond. I love you. So we're gonna keep that 500,000 just for taxes, because we owe about. Oh, we already prepaid 300,000, so we should owe about 100,000 maybe in tax. So I'll just keep that money in cash. So I'm gonna get rid of that. Let's do a portfolio update. So as of right now, our cash is 484,031 in cash. Our stocks have just been booming. Stocks have been booming. We don't have any government bonds. We don't have any corporate bonds, so that's irrelevant. But we have so we have about 4.310 laddering. So that's good to know that we're laddering it. So 2051, 2053, 2066. That's the one odd one, but most of this is laddered. So we're pretty much good when it comes to liquidity, and we're still making interest. Like, look how much money we're making a year. We're making $289,000 a year in interest income, assuming no defaults from our bond. We're making a bit more money than we did if we just keep that in cash. Thank you, Bond Ladder, and I love you. We have about $589,000 maturing soon. Hype. We'll have 1.3 million soon at the end of the year. So if rates are much higher, by 1 year from now, we'll have about $1.3 million to play with. And we still make some income. That's why I like bond laddering. We'll make almost nothing if we kept it in cash. I.e., look at this. Our interest rates right now, brokers paying us 0.50%. That very liquid bond that matures in 2049 is paying us about 5.2% if we bought more of it now. Or we're making about 1.62. Assuming no defaults, we're gonna do alright. That's the benefits of bond laddering. But if there are defaults, this could end up really hurting us. It'd be interesting if they introduced like CDs and stuff. Like if I could buy certificates of deposit, or if I could buy T-bills in this game, that would be pretty cool. Because then I'll be buying. Or in Canada, we have something called GICs. I'd be buying a ton of GICs at high interest rates, guaranteed. Basically savings accounts, though. So I can see why he doesn't really want to have them in there, because interest rates are going up, and that is hurting the value of our bond portfolio. Especially our, where's our Skyline? Where's our 2066 bond? Want to see how well it actually got hurt a fair amount. But I think if we would have bought a lower coupon paying bond, like a lower yield, it would have got crushed. It would have got crushed. Let's just say we bought a 5.6% bond. Currently, right now, yields are about 7% for the long. So in that case, would be. I think that bond would be crushed if it was a lower coupon paying bond. Oh, whatever. So I'm gonna start doing more bond iron once our money comes in. So we're gonna be getting some money soon. This is the one problem about having bond iron, though, is we have a $589,000 coming due soon, but we don't know when the maturity date is. Well, could have known. But that $589,000 is not in my position right now. It's coming in the future. So that's why it's always nice having a bit of cash. I kept a bit of cash for taxes and to take advantage of these opportunities when interest rates go up like crazy. So once it starts hitting 8, I'm going to start buying maybe a bunch of long bonds. 7% for the short. Okay. Oh. 8. I want 8. There we go. So 8% for the long. How many taxes? We owe about $30,000 in tax. Okay, I'll buy about $500,000 over the long bond. In this case, we do the buy long. We're gonna make about 6.10%. Not bad. So it's about 696. So we're gonna buy about 718. Of these government long bonds, and the default risk is relatively low on these government long bonds. So we bought about 500,000 of them. We have about 100,000, which is going to be used for tax, and we should be receiving about 600,000, almost about that, very, very soon. So that's pretty hype. Personal tax rates have been slashed to 30. Ha 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 ha! Is this good news? This is probably good news for me. Oh! I love you. 13% capital gains tax. Oh my goodness, man. Okay. So now I'm going to go ahead and trim. Because I'm pretty sure if rates continue to rise, this may end up hurting our corporate bond. Or I might as well just reallocate some capital. So I'm going to go ahead and trim out my profit because capital gains got reduced a little bit. Pretty hype. And I'm going to do the $56 it's currently at, 03. So we're going to go ahead and sell 4,800 shares to take away our $200,000 in return. Some of that will be principal, some of it will be interest. So we're going to sell about 4,201 share. What? Oh. Oh, I didn't mean to do that, my bad. 4, 8, 8. I could probably do a covered call too. Basically giving someone the right to buy. It's kind of like I own a house. So in that case, we took home a bit of like a $200,000 in gains. But capital gains taxes have been lowered. That's mega hype. Yeah, so I'm just going to reallocate some capital, and then when I see a good deal in like the long bonds, I'm going to go ahead and go into that. I can sell .20 shares. So we have a little bit more cash now. So if rates continue to rise, I'm hype. But part of me is thinking if they lower the tax rate, that's potentially going to mean that they want rates to be lower because they want to stimulate the economy. So part of me is thinking that interest rates may fall. Yeah, they fell a little bit. Oh, they're going to continue to fall, I guess. Okay, that's great. Okay, I'm going to save the game and I'm going to do a bit of leverage. Because I want to hit 10 million. I want to hit that 10 mil. So this is a very high risk strat. I'm going to go ahead and lock in the long bond. I'm going to take out leverage. I'm going to buy 10,000 of these. Borrow 7 million. Watch me lose everything. This is the fun about doing. So if rates continue to fall, we make bank. If they don't, we lose a lot of money. But I'm pretty sure because they eased the tax rates, that should mean that they're going towards a stimulation of the economy. So that's why I borrowed money during that time. So I was actually kind of right a little bit. It's the benefits of knowing a bit of theory. Whenever tax rates are low, people have more money to spend. When people have more money to spend, the economy tends to do better. There's more jobs. Because, if you're thinking about it, why would I pay 50% in tax? I don't think that's a little bit of an over-dramatic. It's a little bit over-dramatic. But if you have more money to spend, typically the more stimulated the economy will become. Our long bonds, we made 2 million, but the interest rates propped back up a little bit, so that's got me a little bit of anxiety. So I'm going to go ahead and take my capital gain. We're going to go ahead and sell 9,000 of these suckers. We're going to make about $2 million gain. Minus our thing, we make about 4 million. So we have about 4 million. And our taxes, we have made $2.2 million in capital gains. How much do we owe in tax? Taxes, about 344 minus that. So we should owe, hypothetically, $320,000 in tax, which we have plenty of amount to pay. Thank you, government lawn bonds. I appreciate it a lot. We took a lot of risks in that transaction, though, but we boomed our portfolio, and I hit my 10 million. At least for now, I'm happy. So now the name of the game is just try to retain my wealth because I made 10 million. I'm perfectly happy with 10 million. You know, we'd be saying, oh, what did you make? 10 million off bonds? That's quite a lot. Because bonds don't really do much. Oh, damn. I'm so glad I took my profit. Oh my gosh. Interest rates just went hype up. Damn, son. Okay, we're gonna buy 1 million of the lawn. $1 million divided by 719. I should have rounded it to 718, but whatever. There we go. We're gonna put we bought about 1 million, a bit above 1 million in bonds. So we bought a bunch of government lawn bonds. We have our corporate bonds. What's the current year? Current year is 2049. So we should have our Bosch bond should be paid off in full. I think it's gone, yeah. So that's fully paid off. So we have a little bit less than Lateran. It's no biggie. I don't think that's it of Harris. No, I was like, oh, is that enough of Harris Heller's music? And nope. It's pretty good for. Thank you, Streambeats, for keeping me entertained. So if rates continue to rise, I'm going to continually buy more and more lawn bonds. What's that lawn bond for? It's for 2062. We still got a long period until it does come due. Okay. Let's do 1 million about long corporate. So like very, very long corporate bonds. Like let's just pretend that let's just pretend I'm preparing for my retirement. So I want to have like a lot of years of potential income coming in. 2071. Let's buy 1 million of this. Should keep a little bit of money just for tax, just in case, because I don't want to get hit with a giant tax bill. A lot of the time, sometimes in this game, I'll forget I owe a bunch in taxes and I'll get completely messed up. It's about 1 million. So as of right now, we have 2.1 million in tax. Yeah, and so we should owe. Yeah, I think we already paid off our tax. That's good. So I might just keep some cash just for now. But as of right now, we're going heavy into the corporate and the government bonds, just for some good old income. And if we look at our income now, we're making about 311,000 in that, 137,000 minus our taxes. We're making 401. Return bonds of 1.16 million coming due soon, and we have about 3.6 million at the end of the year in just straight cash. And I can put that straight cash to work. It's going to be mega hype because interest rates are just the highest I've ever seen in this entire game, or at least in a long time. Oh, continues to tighten. Let's go. It's going to be mega hype. It's going to be mega hype. Can we sell our bond Laren? Or not really. Publix. We have a bit of a small loss in our Publix bond. It may be worth it to actually take that loss, but like these bigger, like these longer term, potentially not. Like these shorter term bonds, I can actually take these losses and then I can redisperse my capital into longer term bonds. But then if we do that, if rates continue to rise, we're going to be in a lot of trouble. So I'm going to slowly start buying more and more at higher rates. So we're going to do I'm gonna probably buy an extra. This is gonna pay me 6.979%. That's not all that good. I'm gonna aim for a corporate. I want to take a little bit more risk for that potential more reward. I'm gonna buy Disney. Let's buy some Disney. $1 million in Disney bonds coming right up, sir. Divided by, how much is it? 56. So it's 563. 1176. There we go. We're buying up a ton of Disney bonds. Fun times, fun times. 4.9 million in bonds now. We have our good old Disney bonds right here. So it's about time we update our bond portfolio. So as of right now, we have some Publix, which is 2050, Taiwan, etc., etc. Skyline National Grocery. We got this new one right here, and then that is 2071, and we got a Disney bond, which is to 2068. Oh, so it's a little bit more liquid. And we got some Sigma. I may end up buying another super duper long bond, and it's going to be hype. Oh, interest rates. Thank you so much for going up. And you might be asking, like, why am I locking my money in when I know that interest rates perhaps could go back up? Well, I put this $468,000 of capital that I have towards buying more at a higher rate. So that's the benefits of buying a bunch of bonds and having a lot of money to work with you. So I have a lot of money in bonds as of right now. I'm just able to buy a ton that pay me coupons right now, get that income, get that cash flow, and I'm able to redisperse that cash flow into more higher yielding bonds. It's like a giant snowball. And we have our Laren positions that are giving me 1.61 million. So if interest rates hypothetically go to 20, it might suck for a bit, but I know over the long term, it's going to be a great investment for me. So I'm going to put about 1 million into another super duper long bond, and I may stop for a bit. So for like another 2070 bond, 2070, don't know how to pronounce that. Right here, 11%, damn. That mega hype. PMC Serrera. It just sounds like I'm throwing 1 million here, 1 million there, but like I have a general sense on like how much liquidity I want to have to a certain extent. But I am throwing money around like it's crazy, just because I got cash flow for days. I'm gonna buy about 1,400 of these. It's about 1 million. That's just because I know to a certain degree, if I'm making 10% on 1 million, well, I know that basically 1 million times 0.10, we're making about $100,000 off that a year. So in that case, we're making, after tax now, we're making $553,000. So that's almost a year. I'm able to buy almost about $1 million worth of bonds. So if rates continue to rise, as long as we're not using leverage, we should be just fine. It'll hurt our bond value. If rates hit 20, like our bond value, it would be hurt a lot. But I'm pretty sure that interest rates are going to go ease and eventually. When they do, oh, our pub bond paid us back in full. Do we owe any tax? About $30,000 in tax. That's no biggie. We can easily afford that with our coupons. Okay, I'm gonna probably go ahead on our very, very high yield bond. Let's go into a bit more of the junky category. The triple Bs. Technically not junk, but I don't see any super duper long ones besides. Oh, here we go. Paying me about 12% a year. Oh, I also look at the credit rating. That's also important to know too. You're like, oh, what? Because I remember buying a bunch of C bonds and stuff and losing lots of money. 454 2000. It's about 1 million. Bam, we have about $1 million in cash. Oh, I'm gonna love it when interest rates fall, because our bonds are gonna be worth like so much. But we have a little bit of cash. We have our ladder in position, so we're gonna be receiving 1.6 million in bond maturities soon. So it's not gonna be the end of the world if rates decide to rise for the next few years. It's gonna be all right. That's why I love laddering. Kind of forces me to stick to a budget, stick to it. But I could also throw money into bonds at this high environment. Let's just hope in the next 2 years that interest rates crash, because currently it's 2050 and we retire in 2052. So I'm just hoping the next year or so interest rates crash. So they're actually starting to crash. So that potentially means that I could potentially use a bit of leverage. This is a bit stupid, but hey, don't follow stupid. This is the stupidest idea ever. There again, this may work pretty well for me. So we're gonna borrow 9 million to basically buy up a ton of government law bonds, and if interest rates continue to fall, we're gonna make so much money. It's gonna be mega hype. Fall, 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 fall. Did I save the game? I bet I didn't. They're easing, so they're pretty likely to cut interest rates in the next few years. So it's gonna be mega hype. So as of right now, we're making 700,000 in corporate government, 500 in that, 128 in dividends. And we're making 650,000 after tax. Our interest expense is 1 million. We're making 1.3 million off our portfolio. So as long as interest rates go down a little bit, we should be able to make a bit of a spread between the rate we invest and the rate we pay out to the margin guy. We're making about 1.6 million, and plus we're having 1.6 million dollars of maturing bonds come due. So that's pretty hype too. We're going to be able to pay off $1.6 million of debt. Thank you very much, Publix bonds, etc., etc. So, hey, I think we're in a good position. We are, like if you look over here, we are highly leveraged as of right now. But if Publix, our 2050 bond, pays us, and the other bonds that are doing 2050, like Southwest, if they pay me, I'm expected to make 1.6 million. So that's gonna relieve a bit of my debt. So as of right now, we borrowed 9.6 million. So if it's tracked out by 1.6 million, we'll have a little bit of debt, a little bit less debt. We should be able to be upgraded to maybe A, or we'll still be considered triple B. But if interest rates continue to crash, we'll have less interest to pay because it's variable. That's mega hype. So now we just chill. We've used as much leverage as we can. We borrowed money, which is dumb. I should hard lock myself and not allow myself to use leverage ever in this game, because teaching people, hey, this is how great leverage is. Well, it's a very, very nasty tool, because if interest rates go up, you're in trouble. If they go down this game, it's great. Like, look how much money I'm making now. We're just becoming millionaires. We're 16 mil right now, and it just feels like it's not gonna calm down. Look at this. Oh my gosh. Government loan bonds, 2062. $16 million of them, $4 million gain. I could have hypothetically, bought a 2074 bond, and I could have hypothetically made more because it's got longer duration. And it's a corporate, so it's more risk. But I also want to have zero default chance risk, because if I would have bought this bond over here, there's a chance they could still go bankrupt and I would lose everything, because I think it's better to buy the government for debt in this game. So as of right now, we're paying 7% to the good old margin man, and I think these bonds are paying me a fair amount of interest. So that's mega hype. As long as interest rates continue to crash, we're gonna do all right. Continue to boost up our wealth, and then soon enough we're gonna be retiring, and I'm just gonna do bond ladder until I retire, and I should be able to retain my wealth relatively stable. I think once interest rates hit 3 point, okay, so now I'm gonna government inverted. Mil. Yeah, we're in gravy town right now. We're making so much. Yeah, so I think if you're relatively a low risk investor, you could probably just do corporate, and you could do government bonds, and just do bond ladder. Oh, they're growing more aggressive in London. That should mean that interest rates crash down more. Welcome to multi-millionaire status. Let's go. Oh my gosh, I'm so hyped, bro. If it hits 0.9, I'm gonna lose my marbles. It would end up being like a great idea to do that government bond. So right now, as of right now, we're paying 4.5 to the margin guy, and our government bond, I'm pretty sure it's a little bit inaccurate, but it says it's paying. We bought it $70. So let's just say it's paying $4.25, and we divide that by our $70 we paid, $70.40. So we're making about 6% a year, and we're paying out 4.5 about. So we're making about 1.5%. So right now it might make a little bit of sense maybe to take my profit, but then again, I'm also being greedy because this is a simulation. Tire bonds paid in full. Awesome. So that reduced our debt by like a little bit. It's currently not 2050 anymore. TDP bonds paid in full. Less margin, less debt, more profit. Let's go. Bonds paid in full, right? Yep, $7 million borrowed. Let's go. Okay, I think rates are starting to rise, or at least they're starting to flatten out. So let's go ahead and let's go into profit town. So we bought. It's currently at 109 for the government bond, and we bought 70. So we're making a fair amount of profit. In this case, we're making $18 million. That's pretty hype. Pretty hype. $11 million just in cash and cash equivalents. And that's not including our $7 million in government bonds we own. So right now, welcome to this one. 71. Okay, I'm gonna sell this. Welcome to massive amounts of profit, bruh. 2074. I'm just gonna do some bond iron from now on. We're just gonna try to conserve our wealth. I'm gonna keep champion bond just because. I'm gonna get rid of Disney. I could have probably tapped Disney bond. It's not really the end of the world. I don't need to sell it. But I want to take advantage of this amazing opportunity of 13% capital gains taxes. I love that. If capital gains taxes were much higher, I would have probably just sold those government bonds and just kept the rest of it for a little bit of income. I think that would be nice. But as of right now, capital gains taxes are like rock bottom lows, so I thought, hey, it's probably a great idea just for me to cash out massive amounts. So as of right now, we have about 60 million in cash. Let's go increase that. We're gonna sell this company. You could theoretically keep that into retirement, but I'd rather have some cash, and then we're just gonna do some bond iron until 2052, which we're almost near end of game. So it makes more sense not to take a bunch of risk and keep those bonds. I could have kept them though. I probably would have been just fine. But as of right now, we're making about $63,000 off our broker in interest, just sitting in cash. And corporate bonds, we're making $70,000, $82,000 in dividend income. We're making about $200,000 a year minus tax. It's $150,000, and we owe about. This is our capital gains, $9 million, $1.3 million owed. So that's quite a bit in tax. I could have hypothetically kept that in there, and I could have kept it into retirement. But whatever. So now I'm just gonna be boring and keep this in cash for March, April, May, June, July, August, September, October, November, December, and then bam, we're done. So I'm gonna be boring these next few days and just that's a little bit of a dip because of my taxes, I assume. But as of right now, we're all in cash, so I'm pretty hyped that we did well this time. And we keep our dividend stocks. We could do anything with this 16 million we made. We made it from a lot of high risk ideas, but we could basically do it for anything. We still kept our Skyline bond, which is 2066. Still paid us some decent amount of income. Our Fort James bond, and I'm pretty sure we have some stocks now. Yep, we have Champion. We have some Champion stock. We have some Prudent stock. So the only stock we kept was Champion because we actually made money off of it. So it actually made sense to convert the bond. So the Champion, it's currently at the convertible price. It made sense to convert above 37. As of right now, the share price is 91. So it made sense to convert. We made a bunch of money off Champion too, which is pretty hype. So as of right now, we could say hypothetically, if I want to give this to my kids or whatever, or if I want to, I could just do anything with this money. I'm going to let you guys have the creativity to make your own story at the end of this. You guys can do whatever you guys want with this 16 million. You guys can buy a nice Lambo, nice yacht, or you guys can go ahead and maybe do some options, grow your own, make your own company. Just do whatever you guys want with that 16 million. I kind of showed in this game how it's possible to make 16 million off a very, very boring strategy, buying bonds. I did take a lot of risk to get here. I borrowed a lot of money. Champion stock did a split. But still, we have like a lot of money. I'm gonna let you guys make your own end of this story. It's pretty nice that we grew our wealth to 20 million. We did take a lot of risk getting here, so that's why I suggest that maybe in this game I might consider not doing much risk. Oh, I love these ideas. Today we're making economic history. The traditional measures of fighting deflation and low negative rates of economic growth, such as increasing bank rate, lower interest rates, and expansionary, have all proven ineffective in combating the current economic malaise. We are quite confident that printing up to 3.5 trillion of new currency and distributing it to citizens of urban. Okay, so this is like a very, very easy environment because they're printing that much money. Let's see how this does. So, I like these events. These are probably my most favorite events. This is probably my favorite part of Speculator. Just these events. Because, like, they have to kind of do with that basic economics. I love the creator and how he makes these. Like, he makes, like, $700 oil environments, subprime mortgages. A bunch of these are realistic, but also I like the hypothetical macroeconomic environments that he makes in this game. So, like, this is a one that could potentially be realistic because they've the government right now has been printing a ton of money for the coronavirus pandemic, offering a lot of basically kind of like what this is basically very, very realistic to today's economic environment. So let's see how this reacts. So this is compliments from your friend, the Federal Reserve Board. Basically they're throwing money from a helicopter, and I find that kind of funny. And I'm pretty sure that rates are going to be low for a while. I kind of wish I could see this scenario play out long term. So as of right now, we only have Fort James bond. Right, Fort James, keeping that. Carl, etc. We don't have that. We got rid of this bond. We sold it for a nice, decent profit. We got rid of Sigma. We got rid of Disney. We got rid of National. We got rid of Taiwan. So right now we only have two bonds. We have a convertible for Fort James. We have some individual stocks. Let's just do a quick little stock portfolio review. As of right now, this is how much cash we have. I want to retain my wealth for at least the other few months I have. 937. We have about 2.2 million in stocks. So our stocks have taken a little bit of a dip from last time I saw. Not really the end of the road. We have $0 in corporate bond ladder, but we do have some Skyline. So we have 824,316 in corporate bonds, and those corporate bonds consist of Skyline and Fort James 2053. Our account summary, here it is. So we have about $19 million in net worth. We're considered AAA. This is showing you guys everything. We have buying power at 36 million, so if you want to borrow. We have a borrowing rate of 3.25%. Here's our everything. Here's everything else. So I'm just showing you guys if you guys want to see a clearer picture. So we got some junk bonds, some blue chip fixed income funds, some government security funds, Champion Enterprises. That's the bond that we bought, and we made some good money off of that. I'm pretty hype. Net worth. So here's our chart for our net worth. We started off on, like, this is about 2047. So like, this is definitely not including everything. Cheat? Oh, that's cool. I didn't know you could cheat using this game. I did not cheat. Net worth. My bond portfolio. Don't have any bonds. Only have two, I guess. Options. Haven't done any. Futures. Haven't done any. my trading status. I can see so far, etc. You owe, how many taxes. Oh, I should see this more often. Your tax information. One-tenth prime rate. Oh, here we go. Your investment results have been excellent over the past 5 years, as you have increased your net worth by 330% during that period of the 10 years of the 10 players who started the game. You are currently winning at the moment with the highest net worth. Good job. Thank you, bro. Do margin, etc. How do I see my competitors? My company earnings currently right now, the blue chip index funds sell, strong buy for champion. Here's my annual cash flow. So as of right now, I make $136,000 a year just for sitting on my bum and doing nothing. I could probably make a lot more if I bought more convertible bonds, more bonds, etc. Trade status, network chart. I wonder how my competitors are doing. So this is my chart. I've been kind of flat lately. Help. You can see information, updates, etc. Okay. So what's this? Research. You can see commodity prices, indexes, etc. I already have that up. Just click on anything else that you guys might be curious about. Here's the champion. I think I bought the bond around $20 or whatever. I forgot where it was, but it boomed. It mooned lately. And we got trade. We can do all this stuff. We can do my financial information, corporate information, MISC information. We can view recent headlines, what's going on in the world. But I go on such a fast speed that it's not really, I don't find it super relevant. It may be helpful. You could probably find a few good deals off these news, but I don't really use it. I tend to really, this is my favorite right here. This is what made me my 16 million. Here's how the indexes did. Here's how the prime rates did. Here's how the short bond did. Here's how the long bond did. Here's how silver did. Oil. This would be wheat. This would be corn. Gold. GDP. So I think that's about it. So just seeing where things are at. So we're nearing retirement. Let's have a little retirement party. And the reason why I'm keeping cash, I could have laddered, but I'm just keeping cash mainly right now. How much are we paying in tax? 1.4 million in taxes due. We paid a bunch of money in prepaids. Like $50K a year and just cash just sitting in my bank account. So if you do if you look how much money I'm making off the cash, for the interest rates, I'm making 0.3% on our $16 million in cash. That's just crazy, bro. So I'm just keeping that money in cash just so I don't want it to go anywhere. So as of right now, we're almost worth 20 million. So if we look at game over, we made about 19.88 million, 766,000 as of right now. So note that the two players, 1, 2, 3, 4, etc., how their performance did. Congratulations, Canadian investor has set a new world record, high score. So my record high score of the bond challenge is almost 20 million, 19.888 million. And here's how everyone else did. So this is one of my favorite things, but I couldn't really check on what everyone else was doing. So we made 19 million, and that's just doing bonds. I could have probably made $1 billion plus doing stocks. That's Warren Buffett, but spelled wrong. Canadian investor, Carl Icahn, Gordon Gekko, Donald Trump in this game. Jim Cramer. So I am player 2. So Warren Buffett, he made this much money, so his net worth after tax, after everything, was 3.6 whatever. I ended up with 19 million. So he made $3.6 million. I made 19 million. This guy made about 700,000. 3.6 million, 1.3 million, 800,000, 600,000, 1.3 million, 2 million, 2 million. So we definitely won. We made about almost 20 million. And yeah, and these guys didn't use any debt, or at least any debt at the time being. Net worth 3.6 million for warm budget or whatever. AAA, PMC Serrera. I did buy that stock. I didn't rebuy it. I bought bonds in it. Number of stocks 5. He owned Gens, etc. Me, I made 19 million. My largest stock holding was the High Income Bond Fund, and it was AAA. I owned 4 stocks, which consisted of the High Income Bond Fund, that company, the government one. So I'm pretty sure this was my blue chip bond fund, and that was the Champion. So it was a millionaire investment. So employment status, tech guru. I was a millionaire investor. Pretty hype. This guy's a tech guru. This guy made 700,000. AAA. Wellpoint Wealth was his biggest holding. 10 stocks he owned. AED, etc. Blue chip investor. So he bought a bunch of blue chip stocks. I'm a millionaire investor. I just mainly bought bonds. I beat the bots. That's how good I am. But it's also on difficulty 2. Difficulty 4 would probably been a little bit more difficult. Well, I think there's only 3 difficulties in this game. There's 4 on Wall Street Raider. 3.6 million for this guy. Bank of America was his biggest holding. Never stocks owned 5. And he's a bank analyst, so I'm guessing he just bought a ton of bank stocks. And we got Donald Trump. Financial Equities Fund. So he's a big fan of the financial equities. And he did a bunch of funds, I guess, because like his employment status was funds trader. So I'm guessing he just bought a bunch of ETFs. So that's one thing I'm probably going to be doing in my future. Is 2 challenges I want to do. One, I want to do a high risk strategy, a high risk series, like kind of like doing it live. Because I feel like these games, they have to be played for a long period of time in order for it to be really beneficial. I used to do a lot of shorter videos. 2, and I was thinking about doing an ETF series where I just buy ETFs. I maybe buy a bit of individual stocks and individual bonds, but I want to try to teach the values of buying ETFs. So I think that would be a very interesting series to get into. So almost all of our wealth in that series will be in ETFs. So we're going to be kind of like this guy. 829,000, AAA, 15 companies owned. So he's a I'm guessing he mainly bought biotech and tech companies. Like I see DNA, that's a biotech company. AAPL, biotech. Pretty sure that's Intel. So he's a astute investor. I don't know how to pronounce that. 668,000. Cautious stock trader. So stocks owned. He owned no stocks, but he got completely destroyed. I don't know what he did. I'm guessing he bought bonds just like me, but he didn't time it perfectly. It says cautious stock trader. I'm guessing he just bought very carefully. Energy Bowl, Luco Oil, 1.3 million. Jim Cramer, 2.6 million, 2.06 million. Chevy, bond trader. Oh, how come I didn't get bond trader? That makes no sense. I got millionaire investor. If you look way up here, I actually did bond trading. I'm named a millionaire investor. I'm guessing that's because I won. Yay. But I should have been named a bond trader in the series because that's almost all what I bought is bonds, and I bought individual stocks, but I bought the ETFs, which trade bonds, so I was mainly a bond guy. Samsung, a large cap investor. So I hope you guys enjoyed the video. That's probably good enough. There we go. We're into the series. So final report, we get to see congratulations, pause. Oh, I found this interesting. Most of the real world money professional managers would have a hard time matching your performance over that long term. That kind of money management skill would put you on easy street someday. If you can maintain that rate of return, your compound annual rate of return on your initial capital were given to invest was 19.3% over the period of 30 years. Oh my god. Okay. Time to dick around a little bit. Let's do a compound interest calculator. So we know our compound interest, now we know like our, I don't want this, I want money chimp. So now we know what like my return was. It was 19.3%. So my interest rate was 19.3%. My years to grow, hypothetically, if I wanted to do this for, we did this for 30 years. What if I did this for 60 years? And we started off with 100,000. And if we kept up that return, hypothetically, we did no annual additions, and we compounded annually, it would make about 3.6. So that'd be ones, tens, hundreds, thousands, 10,000s, 100,000s, millions, 10 millions, 100 millions, billions. So if we gave myself an extra 30 years, double the time, I would have been worth a few billion. But if I gave myself an extra 10 years, 166 million. So like if I did 100 years, I'd be worth like a lot. So I found that kind of interesting. What if I did it hypothetically? What if I did it like with like just $100? What if I give myself 30 years and I just start off with $100? I'll be worth 19,000. Interesting. So like this is a good compound interest calculator. There's my return, 19.3 over the period of 30 years. I could probably do much better if I didn't do bonds. So let's go ahead and see over the long term if I can actually beat that 19.3%. So like that's a good so my average return over 30 years was 19.30%. So if I can beat that, it means I'm pretty good. And so I'm going to probably try to do that over a balanced portfolio, or maybe do it for the ETF series or the high risk series. If I can beat 19.3, that's pretty much my benchmark. Cool. And then final report, research menu, and I think that's pretty much it. Here's our chart, and that's pretty much it. That's the end of the game, I guess. So here, I'll make this a little bit bigger. Maybe zoom in. So here's my current year. It's actually retirement. So like if I can get rid of all this, I'm thinking about doing a high risk series, an ETF series, and my average return was 19.3%. So maybe a big question is, if you guys can get this game, Speculator, so I can like get like the it's not that. So if you go over to Wall Street Raider, Ruinsoft. So like this game is not very popular anymore, but like I play it a lot. You can go to Ruinsoft, which I actually found funny because one of the bonds we found was actually there, and we can find like the 2021 update. It talks about what's like been added, new features. There's cash flow now, performance ETF rankings. I actually made up buying. I made up buying another one of the. I might end up buying the new update. New stock trading game. It's technically not really that new, but it's Speculator. So this is how I got Speculator right here. Link is up here. I just googled Ruinsoft. So I just googled right here Ruinsoft Wall Street simulation. Go way down. Go to click here, and then how long does the game last? Limited to 3 years, etc. Go as much as 30. So I did it for 30 years, which is the maximum amount. You can do basically anything. So, and then we got like Wall Street Raider, which is the game that I actually play quite a lot, but I actually like Speculator a lot more because it has to do a little bit more of everything. There's a bunch of YouTube videos for British fans, and you see that. And I'm pretty sure if you want to buy the game, you click this link, or you just get this. You can get the free shareware version right here, so you can try it before you buy it, see if you actually like it. And this is one of my favorite games, not gonna lie, because it's not super duper realistic, but it teaches you a lot of the theory about finance. So I'm a big fan of this game. So, anyways, I hope you guys enjoyed this series. I ended up doing pretty well. I want to try to go ahead and do some high risk, and I want to do some ETFs. And I also want to do some IRL, invest in, do some videos, etc. But anyways, I hope you guys enjoyed this video. Sorry for my long outro. This game took definitely a hefty amount of time to beat. I would say 3 hours plus 3 hours plus 4. Depends how much work you put into it. I think the ETF series might be a little bit shorter. But the high risk series may be a little bit longer than this. Who knows? Anyways, thank you guys very much for watching. I hope you guys have a great day. Bye.